formed in the year 2021 for the benefit of Alex Malezi's two children, Mona and Nora. The following information was provided to you by the trustee in respect of the trust income and expense for the year ended 31st December 2022. Additional information 1. The trustee reported trading profit of 160,000 for the year. This was after deducting the following expense: printing and stationery, 1 million shillings, legal fee. We have the trust agreement. We pick it up.
Greetings and welcome back to the meetings, compliance and administration lesson. Today we are going to study the subtopic complying with requirements of various meetings. Complying with the requirements of various meetings. And candidates, complying with the requirements of various meetings we know is a cornerstone of good corporate governance and legal validity. And in the context of companies in Kenya, compliance is mandatory. And this compliance is primarily governed by the Companies Act of 2015 and the company's own articles of association. So companies, candidates are required to comply with the various laws and rules in relation to meetings. And this compliance, I'm saying, is governed by the Companies Act and the company's own articles of association. And failure to comply with these requirements can have serious consequences, including invalidation of the said meetings, invalidation of resolutions that are made in the meetings. It can have consequences like legal action, fines, and even reputational damage. So in this lesson, we are going to study, first of all, the general requirements for all company meetings. Then we will go ahead to analyze the specific requirements for different meetings. So we begin with the general requirements for all company meetings. What are the general requirements for all company meetings? General requirements. So one is general requirements. General all right. Companies are required to comply with a certain laws or rules in relation to meetings. Now, there are fundamental principles that must be adhered to regardless of the meeting type. That's what we want to analyze here. But later on, we are going to analyze the specific requirements for different meetings, like the annual general meeting, the board meetings, the creditors meetings, extraordinary meetings, and so on. Because before we get to those different types of meetings, let's first of all analyze the general requirements for all meetings regardless of the type. You understand? Now, the first requirement is proper notice. Proper notice. Proper notice. Before any meeting is held, before any company meeting is held, there ought to be a proper notice that is given out. This is the most critical requirement. A notice must be given to every person that is entitled to attend the meeting. And it must be in writing, right? Which can be in hard copy or electronic form. And it must specify the date. The notice must specify the date, the time, and the place of the meeting, as well as the general nature of the business that is to be transacted in that meeting. So the first general requirement for holding company meeting, regardless of the type of a meeting, there has to be a proper notice that is issued to those who are required to attend the meeting. That's number one. The second general requirement is proper authority. There has to be proper authority. Proper authority. What do we mean by proper authority? Now, the meeting must be convened by a person or a body with the legal authority to do so, as stipulated in the company's articles of association or in the Companies Act. Not anyone can convene a meeting. The laws are very clear on who can convene a meeting, be it an annual general meeting or a meeting of creditors or an extraordinary meeting. The Companies Act and the Articles of Association of the company stipulates clearly who is to convene such meetings. So that is the second general requirement of holding any company meeting. The third requirement is in relation to quorum. Quorum. Now, a valid meeting cannot proceed without a quorum. A quorum means the minimum number of members or directors that are required to attend or to be present during the meeting. And this number is typically specified in the company's articles of association. There are meetings that require a certain minimum number of members who are to attend such a meeting. So if the members are not present in that meeting, then that meeting cannot be held. That meeting cannot be held. And if a quorum is not present within the specified time after the schedule starts, then the meeting must be adjourned. The meeting has to be done what? The meeting has to be adjourned. That is the third general requirement. Now, the fourth general requirement is in relation to chairman or chairperson. The chairman or the chairperson. There has to be a designated person. There must be a person, a designated person. In other words, a designated person must chair the meeting to ensure it is considered an orderly and the meeting is held in an orderly and a fair manner. You understand? That's a requirement. A meeting must be chaired by a designated person. And this person ensures that the meeting is held in an orderly and fair manner. Chairman. 5 minutes. That's another requirement for holding a meeting. Minutes. There ought to be detailed minutes of the proceedings that must be kept, and these minutes, okay? The business that is conducted in the meeting must be documented. Detailed minutes of the proceedings must be kept. And these minutes are a legal record of the meeting and must accurately reflect the decisions or resolutions that are made during the meeting. They should be signed by the chairman. These minutes must be signed by the chairman of the meeting or the chairman of the next meeting. Minutes. That is general requirement number 5. And these are the general requirements of holding meeting regardless of the type of meeting. So first of all, I said we are studying the general requirements. The first one being proper notice. Number 2, proper authority. Number 3, quorum. Number 4, chairman. Number 5, minutes. That is the first part of this lesson. Then number 2, we want to study the specific requirements for different meetings. Specific requirements for different meetings. Specific requirements for different meetings. There are different kinds of meetings that a company can hold. One such meeting being the annual general meeting. Number 1, you have the annual general meeting. The annual general meeting. What are the requirements for annual general meetings? Annual general meeting or AGM. Now, an AGM is a formal meeting of the company's members that is held once a year. That's why you are referring to as annual general meeting. Companies are required by law to hold an annual general meeting. So, in studying the requirements of holding a general meeting, then we need to ask ourselves, who must hold an AGM? Who must hold an AGM, an annual general meeting? Now, every company, except for a single member company, every company must hold an annual general meeting each year. And we have even public companies that are required to hold their annual general meeting within 6 months of their financial year end. You understand? Private companies are not legally required to hold an AGM unless the articles of association say so. But public limited companies are required to hold an annual general meeting. Private companies are not required by law to do so. But if the articles of association states that there ought to be an annual general meeting, then such an annual general meeting must be conducted. So then number 2, we need to study the notice. Remember, we say that one requirement for holding any meeting, regardless of the type, is having a proper notice. Now, for a private company, the notice period must be at least 14 days or 21 days as per the Companies Act. But for the public companies, the notice period is at least 21 days. The company articles can specify a longer notice period, but the Act specifies that it has to be at least 21 days. So that is the requirement when it comes to notice of an annual general meeting. Then number 3, the third requirement when holding an annual general meeting is in relation to the business transacted. Business transacted. Business transacted. Now, an annual general meeting typically deals with routine matters, including approval of the company's annual financial statements and reports. Another routine matter could be declaration of dividends. It could be the appointment of the directors or appointment of auditors or appointment and fixing the remuneration of auditors. These are routine matters that are transacted during annual general meeting. So the law is also clear on what businesses or what business ought to be carried out or conducted during the annual general meeting. So that's the third requirement in relation to the meeting we are referring to as the annual general meeting, the A. Then number 4, we can study the procedures. The procedures. Now, to comply, the company must ensure all required documents are circulated to members along with the notice. Now, to carry out candidates an annual general meeting, there are procedures that have to be followed. For example, is ensuring that those who are to attend the meeting have access to the required documents like the annual report, like the financial statement, that ought to be circulated to members along with the notice. So these are the requirements of an annual general meeting. Let's now analyze the requirements of the extraordinary meeting. Extraordinary meetings. This is another type of meeting that can be held by a company. Now, an extraordinary meeting is a meeting of members convened to discuss special or urgent business that cannot wait until the annual general meeting. That's why it's called extraordinary. So the question we need to ask ourselves is, who must hold or who can convene such a meeting? The first requirement, who can convene such a meeting. 1. Who can convene an extraordinary meeting. Now, the directors can convene an extraordinary meeting whenever they deem it fit. You understand? The directors can convene an extraordinary meeting. But members also have a right to requisition such a meeting. Number 2, members' right to convene. The shareholders, apart from the directors, the shareholders may also have a right to do so. The Companies Act gives members a right to convene an extraordinary general meeting. You understand? Members holding a certain percentage of the company's voting shares can compel the directors to convene or to call a meeting. And if the directors fail to do so within a specified time frame, and this time frame is 21 days, then the members can call the meeting themselves at the company's expense. So directors can convene this meeting. The members can also convene the meeting. We are calling the extraordinary meeting. Understand? Yes. Then let's discuss the notice in relation to extraordinary meeting. Notice. 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 Now, the notice period for an extraordinary meeting is generally 14 days. So the notice here is 14 days. 14 days. Then, what of the business that is to be transacted? Business transacted? Business. What business is transacted during an extraordinary meeting? Now, an extraordinary meeting deals with specific non-routine matters such as altering the company's articles of association, approving major transactions, or removing a director, and so on. These are non-routine matters, as opposed to the annual general meeting that deals with the routine matters like the appointment of directors, auditors, and so on. So that is a business that may be transacted during extraordinary meeting. Understand? And it is important to note that a resolution that is passed at an extraordinary meeting is often a special resolution. If resolutions are passed at an extraordinary meeting, it is usually a special resolution. Special resolutions are issued at an extraordinary meeting, okay, which requires a 75% majority of the votes that are cast. And the notice must clearly state that a special resolution will be proposed at the extraordinary meeting. So that's all we can say about extraordinary meetings. This is the second type of meeting. The first type is the annual general meeting. Candidates, we are studying the special or specific requirements for different types of meetings. The first one is the annual general meeting. The second one is the extraordinary meeting. The fourth one is the board meetings. Board meetings. Now, board meetings are meetings of the company's directors to discuss and make decisions regarding the company's management. So what is the frequency of this meeting? So the first requirement is in relation to frequency. How frequent are these meetings held? Now, the company's articles usually specify how often board meetings should be held. So it could be 2 times in a year, 3 times. It depends with the articles of association of the company. What of the notice? Notice. Now, are there notices that are required? Yes. The company's articles of association typically also sets the notice period for board meetings, which can be much shorter and less formal than for general meetings. Then number 3, we have quorum. Are there any requirements in relation to quorum of board meetings? Yes, the quorum for a board meeting is usually specified in the Articles of Association of the company. The Article of Association of the company will specify the quorum that is required for board meetings to be held. Then lastly, we have minutes. Minutes. Now, the Companies Act requires that minutes of all proceedings at board meetings are recorded and kept at least 7 years, for at least 7 years. The minutes must be kept for at least 7 years. And these minutes are a key legal document and can be used as evidence of the board's decisions. You understand? Yes. Then lastly, we have the director's duties. What are the director's duties in relation to these meetings? Director's duties. Director's duties. Director's duties. Now, at all times, directors must comply with their fiduciary and statutory duties to act in the best interest of the company. So when dealing with board meetings, there is a requirement that the directors have to be loyal. The directors are required by law to comply with their fiduciary duties and statutory duties, and these duties require that these directors act in the best interest of the company. And their deliberations and decisions at board meetings must reflect these duties. They must reflect fiduciary and statutory duties. You understand? Yes. So this is the meeting we are referring to as board meetings. Then lastly, let us analyze creditors meetings. Creditors meetings. Creditors meetings. This is a meeting of creditors. Creditors meetings. Apart from the board members, apart from the shareholders, the auditors may also convene a meeting. And these are meetings that are held during the company's liquidation, administration, or restructuring. When the company is restructuring, when the company is facing liquidation, then the company may have to conduct what we are calling the creditors meeting. So what is the purpose of this meeting? One, purpose. What is the purpose of creditors meetings? Now, the purpose of conducting a creditors meeting by a company is to inform creditors of the company's financial status. It may also be to approve the scheme of restructuring or arrangement, or to appoint a liquidator. When a liquidator is to be appointed, then the creditors must be involved, and they can only be involved when a creditors meeting is called. So I've identified for candidates the purposes of a creditors meeting. Number one is to inform creditors of the company's financial status. The second purpose is that the meeting can be held when approving a scheme of arrangement by the company, or number three, when the company seeks to appoint a liquidator. So these are part of the requirements we are discussing. You understand? Yes. Then let's analyze the legal basis. What is the legal basis of holding a creditors meeting? Now, the process for creditors meeting is governed by the Insolvency Act of 2015. So that is a requirement. When conducting a creditors meeting, then the meeting has to be conducted in line with the Insolvency Act of 2015. Compliance. The administrator or the liquidator must comply with the strict procedures and timelines that are outlined in the Insolvency Act, including sending notices to all non-creditors including preparing statements of affairs and also conducting the meeting in a manner that allows for a fair vote. So these are the requirements for holding creditors' meetings. And that's the end, candidates, of today's lesson on complying with the requirements. Complying with the requirements of various meetings. And at the beginning, we did state that complying with the various requirements of various meetings is the cornerstone of good corporate governance. We did also state that failure to comply with these requirements can have serious consequences, including invalidation of resolutions that are made during the meetings, including legal action and also fines and reputational damage. We've gone further in this lesson to analyze the general requirements that companies are required to comply with, regardless of the type. There are fundamental principles that companies must adhere to, regardless of the meeting type. And one such is proper notice, proper authority, quorum, chairman, minutes. Then we've analyzed the requirements for specific meetings. The first meeting type is annual general meeting. We've studied the requirements of extraordinary meetings. Then number 3 is board meetings. Then lastly, we have the creditors meetings. The requirements for creditors meetings. Now, in closing, we can state that compliance with the meeting requirements is a detailed process that requires strict understanding of the Companies Act, the Insolvency Act, the Articles of Association, and the various laws that pertain to meetings. And that requires the company secretary to be quite skilled. A skilled company secretary here becomes an invaluable asset in ensuring that these requirements are met, which then protect the company from legal and financial risks. So that's why we are studying the subtopic on complying with the requirements of various meetings. So as a company secretary, you need to understand what are the requirements of various company meetings, which include the annual general meeting, what are the requirements for the extraordinary meeting, what are the requirements for the board meetings, what are the requirements for the creditors meetings. And that's the end of today's lesson on complying with the requirements of various meetings. Bye-bye. Bye. Greetings, candidates, and welcome to the Manifested e-learning platform. The subject is Advanced Financial Management. We continue with the topic mergers and acquisitions. In today's session, we're going to discuss the arguments for and against the use of mergers and acquisitions as tools for corporate expansion. Why would companies choose to merge? Why would a company choose to acquire another one as a tool for corporate expansion? Because by now we are aware that mergers and acquisitions are tools that companies use for corporate expansion, but these tools come with both potential benefits and significant risks, benefits and disadvantages, advantages and disadvantages. These advantages are what we are calling arguments for mergers and acquisitions. So what are the arguments for the benefits? We begin with the benefits, then we'll move on to the disadvantages. Why would companies choose to merge or companies choose to acquire other companies. One reason is to increase market share. Increase market share. One obvious benefit that may accrue to a company, increasing the market share. Acquiring or merging with a competitor can rapidly expand a company's customer base and market presence. That is one benefit. Second benefit for mergers and acquisition is the economy of scale. Economies of scale. Combining operations through merging can lead to cost savings through shared resources, bulk purchasing, and streamlined processes. That can lead to economies of scale. Access to new markets. New markets. Mergers and acquisition can provide a company access to new markets and technology. Mergers and acquisitions, in other words, can provide a quick entry into new geographical regions or access to innovative technologies that would take years to develop organically or internally. Instead of a company waiting to grow organically, to grow internally, the company can choose to merge with another one so that the benefits can be enjoyed quickly. Access to new markets. Technology. Number 4 benefit is diversification. Diversification. How is diversification a benefit? Now, acquiring companies in different industries can reduce risk by diversifying revenue streams. Diversification. 5 is enhanced competitive advantage. It can lead to enhanced competitive advantage. Mergers and acquisitions can lead to enhance competitive advantage by combining strengths. When companies come together, companies combine strength, that can create a stronger and more competitive advantage. 6, faster growth. Faster growth. Mergers and acquisitions can lead to faster growth. Mergers and acquisitions, in other words, can allow for rapid expansion compared to organic growth. Now, the list is not complete without mentioning synergy. Synergies. The combined company, after merging, often achieve more together than the individual companies could separately achieve. We always say 2 are better than 1. What 2 companies can achieve together far much outweigh what each individual companies can achieve separately. That's what we're referring to as synergies. So these are 7 benefits. Let's discuss the disadvantages of mergers and acquisitions. Disadvantages or arguments against use of mergers and acquisitions. What are the disadvantages? One is the disadvantages or challenges. We have Integration challenges. When companies merge, there is always that difficulty or challenges when it comes to integration, merging different company cultures, merging the different systems of a company, merging the processes. That can be a complex exercise, and that is one challenge that comes with mergers and acquisitions. How to merge the different corporate cultures, company cultures, the processes, the systems, and so on. 2, cultural clashes. Cultural clashes. Differences in corporate cultures can lead to conflicts. It can lead to employee dissatisfaction and also decreased productivity. Cultural clashes. 3, financial risks. There are also financial risks that are associated with mergers and acquisition transactions, which may involve significant debt. For a company to purchase another company, the acquirer or the predator may be required to seek for debt, which can lead to financial risks. So mergers and acquisition transactions often involve significant debt, and there is a risk of overpaying the target company, which may lead to financial risks. We also have challenges associated with complying with regulations. M&A deals are subject to regulatory scrutiny, particularly the competition laws, which can delay or even block transactions. Another challenge is associated with employee morale, employee morale and turnover. This is yet another challenge associated with mergers and acquisitions. Employee morale and turnover. Mergers and acquisitions can create uncertainty among employees, and that can lead to anxiety, that can lead to decreased morale, and ultimately high turnover is a challenge which the management should take note of during mergers and acquisitions. When employees are told that the company is going to be acquired, that can lead to anxiety, uncertainty, and that affects productivity, and it may increase turnover. That is disadvantage number 5. Number 6 is valuation difficulties. Valuation challenges. During mergers and acquisitions, it may be necessary for the company that's merging or the company that is being acquired to be valued. So accurately valuing a target company can be challenging, and we've seen in the past companies overpaying. That is a common risk, overpayment, because payment is based on valuation. If no proper valuation is done, then company may end up being overpaid and so on, and that can be a great challenge. 7, failure to achieve synergies. Failure to achieve synergies. One of the main reasons for merging and acquiring companies is to achieve synergies. but sometimes the anticipated benefits of mergers and acquisitions may not materialize, which may lead to financial losses. That is number 7. The 8th and last disadvantage here is disruption of core business. Disruption of core business. Disruption of core business. Mergers and acquisitions can sometimes affect the operations of an entity. They can divert the management's attention. Mergers and acquisitions can also divert resources from the company's core business, and that is a challenge. So these are 8 disadvantages or arguments for and against use of mergers as tools for corporate expansion. There are other tools that companies can use when planning expansion, like what we call developing the internal processes can also be another way to expand. You understand? What we call organic growth. A company can grow organically, or company can choose to merge or acquire another one in order to achieve corporate expansion. In our next session, we will be discussing the mergers and acquisitions versus organic growth. For now, we take a break from today's lesson, where we've discussed the arguments for and against the use of mergers and acquisitions. Thank you for attending the lesson. Bye-bye. Hello and a warm welcome to the lesson. The subject is meetings. Today we are going to the second chapter, which is professional framework of the corporate secretarial profession. This chapter has 12 sub-chapters. One is evolution of the corporate secretarial profession. Number 2, legal and regulatory framework. Number 3, role and mandate of corporate secretarial professional bodies. Number 4, procedures on registration and deregistration of a member. Number 5, professional qualifications and qualities of a secretary. Number 6, required knowledge, skills, and competencies. Number 7, appointment and vacation of office of the secretary. Number 8, professional engagement and clearance of a corporate secretary. Number 9, rights, statutory and contractual obligations of a corporate secretary. Number 10, role of a corporate secretary. Number 11, continuous professional development. And number 12, disciplinary procedures of corporate secretary. So these are 12 sub-chapters under the chapter professional framework of the corporate secretarial profession. In this lesson, we begin with the first subtopic, which is the evolution of the corporate secretarial profession. And in studying the evolution of the corporate secretarial profession, we will first of all focus on the global perspective. Global perspective. Global perspective. Then we'll move to case study of Kenya. Global perspective. Global perspective. Now, candidates, the evolution of the corporate secretarial profession marks a shift from a humble clerical role or to a high-level strategic position. Initially, that is to mean that the corporate secretary played clerical duties, but today the corporate secretary sits at the board of a company. The modern company secretaries are now seen as the chief governance officers, or to put it in another way, they are now seen as the guardians of integrity. But traditionally, the corporate secretary performed clerical duties. They had a clerical role. So let's first of all begin with a global perspective of a corporate secretary, beginning with the scribes to strategies. Okay? They were initially scribes, or just individuals in organizations who performed clerical duties, but today they are now strategists because they sit at the board of companies. So the profession has evolved through three distinct historical phases. The first phase is the ancient origins and the scribes. Initially, these were just scribes. So we have the ancient civilization where the secretaries were merely scribes, right? So the first phase, let me put it in phases. Phase one, the first phase is the ancient origins, all right? Now, candidates, don't forget we want to look at the evolution, how the corporate secretary has evolved from ancient origins and the scribes origins and scribes to the modern day strategies. That's phase one. And in phase one, candidates, we have the ancient origins or the ancient civilizations. So we have to first of all identify ancient civilization, because we are studying the evolution. So we are going into the history of the corporate secretary from the ancient civilizations. Candidates, the term first of all secretary comes from the Latin secretarius, which means a person who is entrusted with secrets. The word secretary is derived from the word secrets. So initially, the corporate secretary was an individual who was entrusted with the secrets of an organization. You understand? The word secretary is derived from the Latin word secretarius, meaning a person that is entrusted with the secrets. And in ancient Egypt and even Rome, secretaries were highly educated men who served as confidants to rulers, and they recorded private state matters. You understand? That is ancient Egypt. Ancient Egypt and Rome. These were men. It's important to note that because later on we'll be seeing how there was a shift in gender. Initially, it's only men who performed this role of the secretary. In ancient Egypt and Rome, these were highly educated men as the male gender. They served as confidants to rulers, and they recorded secret state matters. Important to know that is in ancient civilizations. Then we have the Middle Ages. When we fast forward to the Middle Ages, in the Middle Ages, the role was largely clerical. All right, the role was largely clerical. The role was largely clerical. The role of the secretary was largely clerical and conducted by the clergy and conducted by the clergy. The role of the secretary was highly or largely clerical, and it was conducted by the clergy. It was conducted in the Middle Ages by the clergy. It was conducted by the clergy, and they were responsible for record keeping and bookkeeping for the church and the nobility. Largely clerical and conducted by the clergy. That's where we get the origin of the word clerk. The word clerk is derived from the word clergy. So in the Middle Ages, the secretary duties were highly clerical, and they were conducted by the clergy. They were conducted by the clergy. They were responsible for record keeping and bookkeeping for the church and nobility. So that is phase 1. This is phase 1. Then moving to phase 2. Phase 2. Candidates, are you following? We are describing the evolution of the corporate secretarial practice. So we've analyzed phase 1. We are moving to phase 2, which comprises the Industrial Revolution era. Industrial Revolution. This is the Industrial Revolution. During the Industrial Revolution, this is around towards the end of the 17th or 18th century. Industrial Revolution. Industrial Revolution. Most of you have studied history. If you are Kenyan, you must have studied history. You must have come across the era we refer to as the Industrial Revolution, which began in the United Kingdom in the 19th century. All right, so here we have the 19th century. After the Middle Ages, we move to the 19th century. We want to see what was the role of the corporate secretary. Now, as we know very well that during the Industrial Revolution, there was the emergence of many factories, many companies that were jointly owned. The joint stock companies, right? As joint stock companies emerged, the Joint Stock Companies Act in the United Kingdom introduced the need of formal records. There was formal need for records, and that is when the company secretary was born. Though primarily as a servant of the board, the corporate secretary was tasked with organizing meetings. The company secretary was tasked with filing records, and so on. You can see the role has now shifted during the Industrial Revolution, where many joint stock companies were introduced. In the United Kingdom had to enact an act of parliament known as the Joint Stock Companies Act in 1844. In 1844, the United Kingdom enacted an act known as the Joint Stock Companies Act. And through the act, there was formal need for records. The act insisted on a company having formal records. And these formal records were to be kept by the company secretary. The act stated that the company secretary's role, one of the roles was to organize meetings of the board and also to file records. That is the 19th century. Right? You understand? Yes. The Industrial Revolution and legal reforms. That is 19th century. 19th century in UK. United Kingdom. Then it's important at this point to note the shift from the role that was played by men. There was a gender shift. In phase 2, there is now the gender shift. Initially, it was only men that were entrusted with secrets of the state. But with the emergence of industries in the UK, then the role shifted not only to, it was not restricted to men, but also the women. Now, until the late 1880s, the role was male-dominated. But with the invention of the typewriter and the telephone, women entered the workforce, and the role became increasingly associated with administrative support. Before 1880s, it was male-dominated. After 1880s, the field was now open. Women also joined the workforce with the introduction of the typewriter and the phone, and the role of the corporate secretary became largely administrative. That is phase 2. Now moving to phase 3. Phase 3, this is phase 1, then there is phase 3. Now phase 3 is now the current phase, the 21st century. All right, this is the 21st century. In phase 3, we are now in the 21st century, and this is the century of governance professional. In this phase, this is the phase of the governance. This is the phase of governance professional. Governance professional. The governance professional. This is the post-financial crisis. All right? The post-financial crisis. Following major corporate scandals like the one witnessed with the two companies, the Enroll and the WorldCom, global governance codes like the Cadbury, the Sarbanes-Oxley, they redefined the secretary's role. I know you understand what I mean by governance codes. Global codes of governance. Post-financial crisis. Let me put here an S. Post-financial crisis. After the Industrial Revolution later on, the world experienced crisis in major companies. And to address those the crisis and the financial crisis that was that happened, there was need to put in place global governance course, which then guided on how companies are to be managed and run. The governance professional phase. Understand? That's when now we have at this moment what we call strategic advisory. Today, the secretary is a board level officer. Strategic advisory. Strategic. At the moment, the company secretary is a board level officer. They are no longer just note takers or just taking minutes. No, they advise the board on matters to do with law, matters to do with ethics. They advise the board on sustainability issues. They advise the board on strategic matters and so on. That is the 21st century. So candidates, in a nutshell, this is the global perspective of the evolution of the corporate secretarial practice. Now we shift gears to the case study of Kenya. This is global perspective. We move to the case study of Kenya. Case study of Kenya. We are studying Kenya in relation to the evolution of the corporate secretarial practice. Case study of Kenya. Case study of Kenya. What is the Kenya's professional journey? Now, Kenya's secretarial profession has followed a path of rigorous professionalization and legislative reform, and we have had various milestones. Now let's discuss the milestones that Kenya has undergone in relation to the evolution of the corporate secretarial practice. So milestone number 1. We study here the milestones. Milestones. Milestone 1. Milestone 1. The evolution of corporate secretarial practice case study of Kenya. Milestone 1 is pre-1988. That is the pre-1988, the colonial legacy. That's the first milestone, pre-1988. Number 1, pre-1988, the colonial legacy. Colonial legacy. Now, under the old Companies Act that was based on English law, the company secretary was largely a clerical role. There were no strict professional qualifications, and the person was often a lawyer or an accountant performing secretarial duties on the side. This is pre-colonial era. This era, the colonial era, happened up to 1988. Before 1988, which we are referring to as the colonial legacy, under the old Companies Act, because the Companies Act was changed in 2015. Okay, so before then, the company secretary played largely a clerical role. Understand? Then you have milestone 2. Milestone 2. Milestone, the second milestone. Milestone 2, the second milestone, is a professionalization. 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 This is the milestone. We can call it professionalization. And this came about with the enactment of the Certified Public Secretaries of Kenya Act in 1988 that turned things around. The enactment of the Certified Public Secretaries Act in 1988 was a turning point because it established the Institute of Certified Public Secretaries of Kenya. You understand? The enactment of the Certified Public Secretaries of Kenya Act. Right? Let me put it down. The enactment of the Certified Public Secretaries Act 1988 established the Institute of Certified Secretaries, the Institute of Certified Public Secretaries of Kenya, which now is known as the Institute of Certified Secretaries. Okay, it established, which we now know it as the Institute of Certified Secretaries. Because you cannot have professionalism without an institute, without a professional body that regulates the conduct of these professionals. So this act established the formation of the Institute of Certified Public Secretaries, which is now known as the Institute of Certified Secretaries. It created a professional body to regulate, examine, and also license secretaries, ensuring that only qualified individuals could act as secretaries for public companies. That's a very big milestone. Before 1988, the role of the company secretary, we've said, was largely clerical. It was largely clerical. That is the pre-colonial era, colonial legacy. But there is that milestone of professionalism. Then the third milestone is the Companies Act, which is the modern era. The Companies Act. The Companies Act. This is the third, 2015. This is the modern era. In the modern era, we now have the Companies Act. The current Companies Act significantly modernized the role of the company secretary. The company secretary is now has what we call an officer status. The Act explicitly recognizes the secretary as an officer of the company. The company secretary is now recognized by the Act as the officer of the company, right? Carrying legal liability for non-compliance. The company secretary now carries a legal liability for the company for non-compliance. The Act introduced a threshold where only private companies with a paid-up capital of, say, 5 million or more are mandated to have a secretary. That is the threshold. For companies, for private companies, there's a threshold. Understand? But all public companies must have a company secretary. That is the law. All public companies, number one, this is the schedule. All companies, public companies, are required by law to have a company secretary. But for private companies, there is a threshold of 5 million Kenya shillings or more. A company with 5 million shillings or more paid up capital is also required to have a company secretary. You understand? Yes. That is a big milestone. The third milestone. The third milestone, the Companies Act, the modern era. You understand? So there is, first of all, official status. I've mentioned official status. The company secretary now has an official status. Is recognized as an officer of the company. Officer status. Officer status. The company secretary now has officer status. That is number one. Number two, the second thing that the Act did was to introduce thresholds. It introduces thresholds. Then the third important thing here is the strategic shift. There's a strategic shift. Because here we've seen pre-colonial era, the company secretary largely played clerical role, but here is playing strategic roles. So there is a shift during the third milestone. So these are three important points that we draw from the Companies Act of 2015. That is during the modern era, and we are discussing today. This is 2026. In 2026, after the enactment of the Companies Act of 2015, during the modern era, 2016, we are deferring to the modern era. In the 21st century, the company secretary is recognized as the officer of the company, is explicitly recognized as the secretary, as an officer of the company, carrying legal liability for non-compliance. There is also thresholds where all public companies are required to have a company secretary, and all private companies with paid up capital of 5 million or more are also required to have a company secretary. So that is the modern era. Then there is the last milestone, which is the fourth milestone. Milestone number 4. Milestone number 4. Now, milestone number 4 is the milestone of the governance codes. Here we have governance codes. Governance codes. For example, now that we are discussing case study of Kenya, we have the Mwongozo Code. For example, the Mwongozo Corporate Governance Code. The Mwongozo Code for state companies. The Mwongozo Code for state companies. Code for state companies. Then we have the Capital Markets Authority, right? The introduction of Mwongozo Code for state corporations and the CMA Corporate Governance Code. CMA Corporate Governance Code. The fourth milestone is a milestone of governance codes. And candidates forget, we are studying the evolution of the corporate secretary practice, a Kenyan case study. So we have the fourth milestone, which is the governance codes era. We have two codes that we can cite: the Mwongozo Code for state corporations. Then we have the Capital Markets Authority Corporate Governance Code for listed companies, right? This code is for, let me be specific, for listed companies. For listed companies, which has placed the certified secretary at the center of institutional integrity. Which has placed the company secretary at the center of institutions' integrity. We are talking about governance codes, the code of governance. How these are guidelines that govern how companies ought to operate. And the certified secretary has been placed at the center of institutional integrity. They are now tasked with conducting governance audits, and they are also tasked with the responsibility to ensure that the companies are run ethically. They are to ensure organizations are ethically sound. So that is the evolution candidates of the secretarial practice. Global perspective and Kenyan case study. That's the end of the lesson on evolution. And in studying the global, just to do a recap, global perspective, there are how many phases? 3 phases. The first phase is the ancient origins and scribes. This is the era of ancient origins and scribe, which we did indicate that during the ancient civilization, number one, we have ancient civilization. During ancient civilizations, particularly in Egypt and in Rome, the profession, I mean, the term secretary, we've said, is derived from the term secretarius, meaning a person entrusted with the secrets. And these persons were entrusted with the secrets of the state. The ancient Egypt enroll. And these persons were men during that time. Men. That is ancient civilization. Then there is the Middle Ages. During the Middle Ages, the role was largely clerical, and it was conducted by clergy. That's where we get the word clerk. They were conducted by the clergy for the church. They were conducted by the clergy for the church. They were responsible for record keeping and bookkeeping for the church and for the nobility. That is during the Middle Ages. So during phase 1, we have 2 things: ancient civilizations and the Middle Ages. Then in phase 2, global perspective, we have the Industrial Revolution, with the emergence of many factories and farms which were jointly owned, the joint stock companies. Then there was a gender shift with the introduction of the typewriter and the telephone. The women joined the workforce, and at this point, the role of the secretary was largely administrative. During the 19th century, particularly in the UK, the Industrial Revolution happened in the UK, where we had so many joint stock companies that were formed. Understand? Yes. Then phase 3 is the governance profession. We have the post-financial crisis. We had many companies experiencing financial crisis, like the Enroll and the Welcome. Many of them experienced crisis because there was no experience on how to manage companies. Before Industrial Revolution, there were no industries before towards the 18th, end of the 18th century. So there was no experience on how to manage companies. And we know companies are run by human beings. And human beings, they have the tendency to be corrupt. So because of corruption and fraud, many companies experience financial crisis. And as a result of that, then there was as a result of this crisis that happened, following major corporate scandals, global governance course like the Cadbury redefined the secretary's role. There was need to have governance or how to manage companies. So there were roles that were introduced. There was now the strategic advisory role that was to be played by the company secretary. Understand? Yes. Today, the secretary is a board level officer. They are no longer just take notes or take meetings. They advise the board in law, in sustainability strategy, and so many areas. That's it for the global perspective. Then we've gone through the case study of Kenya. There are 4 milestones. Milestone 1 is a pre-1988 colonial legacy era, which the company secretary roles was largely clerical. Then there's milestone 2, the era of professionalism. That was the enactment of the Certified Public Secretaries Act, which introduced the Institute of Certified Secretaries. With this institute, then this institute regulates the conduct of these professionals. That is milestone 2. Milestone 3, there is the Companies Act. All right, this is the modern era. In the modern era, under the Companies Act, the company secretary is recognized as the officer of the company. There are also thresholds in the Companies Act where all public companies are required to have a company secretary, and the private companies that have paid up capital of 5 million and above are also required to have a company secretary. The role now again shifts here to strategic. There is a shift. Kenyan perspective, the law gives now given that the officer of the company sits at the board, it now plays strategic role at the board. That is milestone number 3. Milestone number 4 is the governance codes. We have in Kenya now the Mwongozo Code for state corporations. Then there is a Capital Markets Authority corporate governance for listed companies, which has placed the company secretary at the center of institutional integrity. So that is the journey, okay, the Kenya's professional journey as far as company secretaries are concerned. That's the end of the lesson. In our next session, we are going to proceed with this chapter on professional framework of the corporate secretarial practice. We are going to study the legal and regulatory framework. Bye-bye. Hello and welcome to the lesson. The subject is business and data analytics. Today we are going to study the various types of data analytics. By the end of this lesson, you should be able to explain at least 3 types of data analytics. Types of data analytics. Types of data analytics. Data analytics, learners, is a broad field, and there are 4 main types of data analytics. There are 4 main types of data analytics. Number 1 is known as descriptive analytics. Number 2, diagnostic analytics. 3, predictive analytics. 4, prescriptive analytics. 4 types. Descriptive analytics, diagnostic analytics, predictive analytics, and prescriptive analytics. Now, each type here has a different goal and a different place in the data analytics process. Descriptive analytics is the first one. Descriptive analytics helps answer questions about what happened. Answer questions about what happened. What happened. And the techniques here summarize large data sets to describe outcomes to the stakeholders. And by developing the key performance indicators, all right, the strategies can help track successes or failures. And we may also have specialized metrics that are help to track the successes or the failures in an industry. We could have metrics such as return on investment, which is used in many industries, and so on. So the process here requires the collection of relevant data. Here, it requires the collection of the relevant data, the processing of the data, data analysis, as well as data visualization. And the process here provides essential insight into the past performance, because data analytics answers the question, what happened? It looks into the past, the history, what happened in the past, what is the past performance, and so on. So descriptive analytics looks into the history, into the past, what happened. The second type of data analytics is diagnostic analytics. And here, diagnostic analytics helps answer the questions about why things happened. Why things happened. This is what happened. Diagnostic answers the question, why things happened. And the techniques here supplement more basic descriptive analytics. They take the findings from the descriptive analysis and digs deeper into the cause of what happened. And the performance indicators are further investigated to discover why they got better, why things got better, why things got worse, and so on. And there are various steps in the diagnostic analytics. The first step being the identification of anomalies in the data. And the anomalies may be the unexpected changes in a metric or a particular market. The second step in the diagnostic analytics is the collection of relevant data. Collection of relevant or related data. This is data that is related to the anomalies. Okay? So first of all, I've said the first step in the diagnostic analytics is to identify anomalies in the data. Then number two, data that is related to the anomalies is collected. Identify anomalies in the data, then collect data related to the anomalies in the data. Then after that, statistical techniques are used to find relationships, to find trends that explain the anomalies. That is diagnostic analytics. I repeat, identify anomalies, step number 1. Step number 2, collect data related to the anomalies. Then number 3, use statistical techniques to find relationships, to find trends that explain the anomalies or the cause of the anomalies. Let me put that down. 1, identify anomalies in the data. 2, collect data related to anomalies. 3, use techniques to do what? To identify the, or to find relationships, to find trends that explain the anomalies. Use mathematical or statistical techniques to find relationships and trends in the anomalies. The third type of data analytics is predictive analytics. Predictive analytics, on the other hand, helps answer the question, what will happen in the future? Predictive analytics helps answer the question, what will happen in the future? And the techniques, the techniques here use historical data to identify trends, then determine if they are likely to recur. The predictive analytical tools provide valuable insight into what may happen in the future, and its techniques include a variety of statistical as well as the machine learning techniques, such as the neural networks, the decision trees, the regression, and so on. So based on historical data, the predictive analytical tools can help the firm answer the question, what will happen in the future, by looking at trends in the historical data, the past performance. Predictive analytics, from the word predict. These tools may help a company to answer the question, what will happen in the future? Tools such as regression, machine learning, and so on. Do you understand? Yeah, that is pretty clear. Predictive analytics. Then the last type of data analytics is prescriptive analytics. Prescriptive analytics helps answer the questions about what should be done. What should be done? What should be done? Prescriptive analysis helps answer the questions about what should be done. What should be done. And by using insights from the predictive analytics, data-driven decisions can be made. Data-driven decisions can be made. Based on predictive analytics, data-driven decisions can be made. And that allows businesses to make informed decisions in face of uncertainty. And candidates, prescriptive analytics techniques rely on machine learning strategies that can find patterns in large data sets. Patterns in large data sets. And by analyzing past decisions, by analyzing past events, the likelihood of different outcomes can be estimated. All right? Prescriptive analytics help answer the question, what should be done? This type of data analytics provide insights about insights that businesses need to make effective and efficient decisions. They provide insight that businesses need to make effective and efficient decisions. So these are 4 types of data analytics. We've said data analytics is a broad field. We've briefly described 4 types of data analytics. The first one being descriptive analytics, which we've said answers the question, what happened? Diagnostic analytics answers the question, why things happened. Number 3, predictive analytics answers the question, what will happen in the future. And lastly, prescriptive analytics helps answer the question, what should be done about what should be done by using insights from predictive analytics. We've said also that data-driven decisions can be made. Data-driven decisions, because the decisions are based on past data, on past big data. So these are 4 types of data analytics: descriptive analytics, diagnostic analytics, predictive analytics, prescriptive analytics. Here is your today's assignment. Explain 4 types of data analytics, and when doing the assignment, make sure your notes, you don't make reference to notes, you don't make reference to videos. Try and see if you can recall what you have learned from your memory. Thank you. Bye-bye. Greetings, candidates, and welcome back to the Advanced Financial Management class. Today we continue with the topic mergers and acquisitions. So far we've studied the nature of mergers and acquisitions. We discussed the arguments for and against the use of mergers. We went ahead to highlight some of the evaluation models, the defense tactics against hostile takeovers. Today we move on to the next subtopic, which is financing of mergers and acquisitions. Now, after the evaluation of a target, the company has to figure out which method to use to finance the acquisition. And there are various ways. The company can choose to do what we call outright purchase using cash. There could be share for share exchange, share debenture exchange, and share preference exchange. In this lesson, we're going to discuss the various methods that can be used in financing mergers and acquisitions. And the first method is outright purchase using cash. Outright purchase using cash. The second method is share for share exchange. Number 3, we have the share debenture exchange. Share debenture exchange. 4 is the share preference exchange. Outright purchase using cash, number 1. Number 2, share to share exchange. Number 3, share debenture exchange. Number 4, share preference exchange. In this lesson, we're going to highlight the advantages and disadvantages of these methods. We're going to also discuss how the methods can be used. First of all, let's begin with the share purchase using outright cash. Share purchase using outright cash. After valuation of a target, the acquirer may decide to pay or to purchase the target using cash. So when discussing the financing of mergers and acquisitions, an outright purchase using cash refers to the straightforward transaction where the acquiring company pays for the target company entirely with cash. Entirely with cash. If the agreement is, say, 100 million, the acquirer pays the 100 million transaction in cash. Straightforward. Do you understand? So the target company shareholders receive immediate cash. They receive immediate cash payment for the shares. They receive immediate cash for their shares. So shareholders of the target company receive immediate cash for their shares. They receive immediate cash for their shares. So that is one feature of outright purchase using cash. It is a very simplified transaction compared to other financing methods like stock swaps or cash acquisitions, and cash acquisitions tend to be simpler compared to share, compared to share debenture exchange, compared to share preference exchange. This one is simpler. It is a simpler transaction. It's like going to a yard and just paying for a car, or going to a market and you pay for a commodity. It is simple. You pay the seller and the transaction ends there. There are very few complexities related to valuations and potential fluctuations in stock prices. Another aspect here is control and ownership. Control and ownership. The acquiring company gains full control, full and immediate control of the target company. And there is no dilution of ownership. There is no dilution of ownership for the acquiring company's existing shareholders. Control and ownership is immediate. Financial resources. This method requires financial resources. For the target company to effect this transaction, for the acquirer to effect this transaction, then the acquirer has to have financial resources. Financial resources. The method requires the acquiring company to have substantial cash reserves, or the company should have the ability to raise significant capital. You understand? So this method comes with the advantages, what we call pros, and disadvantages, what we are calling cons. Now the first advantage of financing of mergers and acquisitions using outright purchase using cash is certainty for the seller. Certainty is an advantage for the seller. The target company shareholders receive immediate and guaranteed payment. Immediate and guaranteed payment, which then eliminates uncertainties associated with stock fluctuations. There is that element of certainty. Simplicity, speed and simplicity is another advantage. Speed and simplicity. Here we say that is a simple transaction. Cash transactions tend to be quicker and less complex than those involving stock exchanges like the share-to-share exchange, the debenture, share-debenture exchange, and so on. Simple and quick. Speed and simplicity. Clear valuation. Clear valuations. Now, how is clear valuation an advantage associated with the outright purchase using cash? Now, the price is clearly defined. Before the payment is done, the price is clearly defined. Clearly defined, which reduces then valuation disputes. Clear valuations reduces valuation disputes. Maintains control. Is also an advantage associated with control. Control. The acquiring company retains full ownership and avoids diluting its existing shareholding or its existing shareholders' equity. Another advantage is positive market perception. Positive market perception. Positive market perception. How is positive market perception an advantage? Positive market perception. How is it an advantage? Now, candidates' cash deals can often signal financial strength to the market. When the market hears that company A has acquired company B with an outright purchase using cash, then it sends a signal, an indicator that company A is doing well, and investors would want to be associated with companies that have strong financial muscle. So these are 5 advantages, but you also have disadvantages. There are some disadvantages that are associated with the financing of mergers using outright cash. One is financial strain. It can lead to financial strain, particularly where the target is overvalued. Large cash outlays can deplete the acquiring company's financial reserves, which then potentially hinders future investments or operations. Opportunity cost. Opportunity costs. Using cash for acquiring a company means that those funds are unavailable for other potential uses, such as research and development, such as expansion, and so on. Funding requirements, number 3. Funding requirements. If the acquiring company lacks significant cash, it may need to borrow. It may need to do what? To borrow. It may need to increase debt. Then that leads to what we call debt load. And debt load, we know, is associated with the interest expenses which are fixed. That is a disadvantage. If the company lacks money from its internal sources, then the acquiring company may be forced to borrow, and that increases its debt load, and it increases the interest charges that are associated with debt funding requirements. There could also be tax implications. Tax implications. For the seller candidates receiving cash, creates an immediate taxable event. Okay, there is an immediate taxable event, and that could lead to capital gains taxes, which will be due to the seller. So that is all we can say about outright purchase using cash when financing mergers and acquisitions. So this is the first method. Now the second method is share-to-share exchange. Share-to-share exchange. B, share-to-share exchange. Share-to-share exchange. Share-for-share exchange is another method that a company may use to finance mergers and acquisitions. Now, when discussing the financing of mergers and acquisitions, a share-for-share exchange is a crucial method to understand before settling on which method to use. Companies have to consider the share-for-share exchange method. And in essence, share-for-share exchange is a transaction where the acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. Share-for-share exchange. It's self-explanatory, is it not? The acquiring company offers its own shares to the shareholders of the target company in exchange for their existing shares. So if company A is acquiring company B, so this is the acquirer and this is the target, the predator. This company has shareholders, this company has shareholders. This company is buying company B. This company B is owned by existing shareholders. So instead of paying the existing shareholders cash, as we saw in the first case, this company can offer its own shares to company B. Because once company B is acquired, this company ceases to exist. So instead of these shareholders being granted or given cash, they become shareholders of company A by virtue of the shareholding that they receive in exchange for existing shares. So they have to relinquish their own shares in company B, and for them to relinquish these shares in company B, they are given company A shares. The acquiring company offers its own shares to the shareholders of the target company. And that is in exchange for their existing shares. So they are not given cash, they are given shares of company A. the acquirer. And that means that instead of receiving cash, the target company's shareholders become shareholders of the acquiring company, to put it differently. And a critical element here is the exchange ratio. Okay, there has to be a ratio. A critical element in share for share exchange is the exchange ratio, which determines the target company. You understand? The exchange ratio, which we will be learning how to calculate later on. But you have to get that understanding. You need to understand what is share for share exchange. Now, one of the key features of share to share exchange is that it's equity based. This method is equity based. We are talking about share to share exchange. It is equity based. It's based on equity. The method primarily involves the exchange of equity rather than the exchange of cash or debt. Another feature associated with what is dilution. Another feature associated with the exchange, the share to share exchange, is dilution. Now, the acquiring company issues new shares, which then dilutes the ownership percentage of its existing shareholders. If, for example, there were only 10 shareholders, when new shareholders are introduced, say 20 shareholders are introduced, then there is dilution of shares. There is dilution. The existing company, after issuing new shares, dilutes the ownership percentage of its existing shareholders. So these ones were holding equally, say equal, maybe each is a tenth of the shareholding. When you have 20, they will no longer be controlling, each shareholder will no longer be controlling 10%. The percentage will be diluted by virtue of having many shareholders in dilution. Another feature associated with the share to share exchange is the aspect of valuation. Accurate valuation of both companies is essential in order to determine a fair exchange ratio. The companies must be properly valued in order to have a fair exchange ratio. There could also be tax implications. In some jurisdictions, this type of exchange can be structured to be tax deferred, which can be a significant advantage. Now, why would a company then prefer share to share exchange and not outright cash or share to debenture exchange? Why do we have some companies preferring share to share exchange? That is a question that we may want to answer. Companies use share to share exchange in mergers and acquisitions for various strategic reasons. And the reasons are structured around financial flexibility. They are structured around alignment of interests and also tax advantages. One reason is to conserve cash. companies would prefer share-to-share exchange as opposed to outright purchases in cash in order to conserve cash. That is the primary reason. The primary reason a company will opt for share-to-share exchange is to conserve cash. Instead of paying cash for the target company, the acquiring company offers its own stock. And that is especially important for companies that want to preserve their financial resources. So that instead of paying the target company, that money can be invested. That's one reason. Another reason is associated with large acquisitions. Large acquisitions, another reason. Now, large acquisitions, a cash purchase might be prohibitively expensive, which makes share-for-share exchange a more viable option if you have a large acquisition. If the target company, if the acquirer is to pay large sums of money to the target, the only viable solution will be share-to-share exchange. Yet another reason is aligning of interests. Aligning of interests. Aligning of interests. Now, when the target company shareholders, for example, receive shares in the acquiring company, they become shareholders in the combined entity. And that aligns their interests with the acquiring company's interests, which then encourages them to support the integration process. You understand? Yes. Because they are now part of the ownership of the acquiring company. To align the interests of both the target company and the acquiring company, the share-to-share exchange method is preferred. Tax advantages. Now, candidates, in some jurisdictions, a share-for-share exchange can be structured as a tax-deferred transaction. It can be structured as a tax-deferred transaction, which means that the target company's shareholders do not have to pay capital gains taxes until they eventually sell the shares of the acquiring company. Deferred. That's why I refer to it as deferred. It is a tax-deferred transaction. Tax-deferred transaction. Because it is a share-to-share exchange, the shareholders of the target, as opposed to the cash method, they are not required, may not be required to pay capital tax gains after selling off the company. They may be required to to pay tax gains after selling the shares that they receive from the acquiring company. So that is another reason. There are no capital gains taxes that are paid when this transaction is being carried out. And that is a tax advantage. That tax advantage is attractive to the shareholders. It makes the deal more attractive to the target company's shareholders because it allows them to defer paying taxes on their gains. They gain by joining the acquiring company without making any taxes, without paying taxes. So that's an advantage. That is a reason. Reason one is conservation of cash. Number two, we've said it aligns the interests of the shareholders. Number three, we've seen it has tax advantages. Number four, the fourth reason why share-to-share exchange is attractive is flexibility in negotiations. There is flexibility in negotiations. Offering shares can be a flexible transaction tool, allowing companies to structure deals that meet the needs of both parties. Because using shares can help when there are disagreements on valuations. If there are any disagreements on valuations of both the companies, the disagreements can be resolved when financing using share-to-share exchange method. You understand? That it allows for flexibility in negotiations, because the target company shareholders are not being paid off and they go away. No, they still become part of the new entity. They become part of the shareholders, the owners of the acquiring company. So it becomes very easy to negotiate or to iron out any disagreement that may arise during valuation. Understand? There is also another reason. It maintains financial stability. Financial stability is maintained. You understand? Share for share exchange prevent the acquiring company from having to take on large amounts of debt. So these are the advantages. These are the reasons why share-to-share exchange is preferred or may be preferred. But does that not mean that this method does not have disadvantages? There are also some disadvantages that are associated with or challenges that are associated with the method. So what are the disadvantages? Now, the first challenge of share-to-share exchange method is dilution of ownership. Dilution. It's obvious. Dilution of ownership. Issuing new shares dilutes the ownership stake of the acquiring company's existing shareholders. That is obvious. There could also be valuation challenges. 2, valuation challenges. Valuation challenges. Determining a fair exchange ratio can be complex and contentious because it requires accurate valuations of both companies. And there could also be fluctuations in stock prices which can further complicate the process. Market volatility is another disadvantage. Market volatility. The value of the shares received by the target company's shareholders can fluctuate, which creates uncertainty and potential losses. Complexity. Is a challenge. How is complexity a challenge? Share for share exchange can be a complex transaction which requires careful legal and financial planning. There is dependence again on stock performance. E, dependence on stock performance. Dependence on stock performance. The value of the deal is tied to the performance of the acquiring company's stock. And if the stock performs poorly, then the deal becomes
less valuable to the to the shareholders of the target company. So candidates, that's all we can say about the share to share exchange. We've highlighted the features, the advantages and the disadvantages. Let's move on to the fourth or the third method. The third method, that is C. Share debenture exchange. Share debenture exchange is yet another method that can be used in financing mergers and acquisitions. Now, a share debenture exchange refers to a financial transaction often occurring during mergers and acquisitions where a company offers a combination of its own shares and debentures to the existing shareholders of another company. And at this stage in your professional journey, I know you have you fully grasp the meaning of a share. Shares, we know, represent ownership in a company. When you hold shares, you own a portion of that company. So shareholders may receive dividends, which is a portion of the company's profits, and may have voting rights. That is the meaning of share. A debenture, on the other hand, these are debt instruments. They are essentially loans that are issued by a company. And debenture holders are creditors and not owners, like the shareholders. They are not owners, they are creditors to the company. And they receive fixed interest payments. Debentures, something to note again here, are essentially unsecured. They are typically unsecured, meaning that they are not backed by specific assets. And therefore, a share debenture exchange involves providing the target company shareholders with a mix of ownership and debt in acquiring the company. In the acquiring company, that is. So the existing shareholders of the target, after the deal, they are given a mix of ownership and debt in the existing acquiring company. Do you understand? The share debenture exchange, I repeat, involves providing target company shareholders with a mix of ownership, which is represented by shares, and debt, which is represented by debentures in the acquiring company. And this strategy, candidates, can be particularly useful in mergers and transactions because it offers a blend of potential for capital appreciation through shares and stable income stream through debentures. You understand? By having a mix of shares and debentures in the acquiring company, the shareholders of the target company can enjoy the benefits that come with capital appreciation, but they also enjoy some level of fixed interest payments because of the debentures. So the question we need to ask, why companies use this method? We know companies use share debenture exchange for various strategic reasons. And one main reason is to offer a more appealing and flexible deal structure. So one reason or advantage is to attract a wide range of investors. Attract wide range of investors. To attract a large or wide range of investors. This method appeals to investors with varying risk appetites, because we've seen that debentures offer a stable income stream through interest payments, while shares provide the potential for capital appreciation. So you may have investors who are looking for both capital appreciation and the potential for the fixed interest payments. Flexible financing. It is a flexible financing method. There is flexibility. The share debenture exchange allows for a greater flexibility in structuring the mergers and acquisition transaction, because companies can tailor the mix of shares and debentures to meet the specific needs of the target company's shareholders. 3, there is a reason in relation to the lowering of interest costs. Lowering interest costs. Often candidates, the debentures offered are convertible. The debentures that are offered to the shareholders of the target company are convertible debentures, meaning that after some time, the debentures are converted into shares. They can be exchanged for shares at a later date. That's the meaning of convertible debenture. The debentures that are mostly used in these transactions are convertible debentures. And this conversion feature can make debentures more attractive to investors, which allows the acquiring company lower interest rates. Deferred equity dilution. Deferred equity dilution. Deferred equity dilution. What does that mean? Now, the equity dilution from issuing new shares occurs only upon conversion of the debentures. So if debentures are converted after 10 years into shares, then the dilution is deferred. Dilution can only happen after 10 years. That's an advantage. Deferred equity dilution. And that allows the acquiring company to manage the dilution over time. Next, bridging valuation gap. Another reason why this method is attractive is the aspect of bridging valuation gap. Bridging valuation gaps. In situations where, for example, there is a disagreement there could be a disagreement on the valuation of the target company. But you see, this method is offering a mix of shares and debentures, which can serve as a compromise. Number 6 is provides income and growth potential. Provides income and growth potential. This method provides income and growth potential. Income and growth potential. And it's more appealing to investors. So this aspect provides income via the debentures and growth potential via the shares or the conversion of the debentures into shares. So a share to debenture exchange comes with the advantages. One, attracts wide range of investors. Number two is flexible financing. Number four is lowest interest cost. There is the deferred equity dilution. It bridges valuation gaps. It also provides income and growth potential. There is potential for income through the debenture interest payments and potential for growth through the shares that are offered to the shareholders of the target company. All right. Now let's move on to the last method, which is the share preference. The share preference. The share preference share exchange. Share preference share exchange. The share, this is the ordinary share, this is the preference share. The share preference share exchange. The share preference share exchange. Now, share preference share exchange in the context of mergers and acquisitions. In the context of mergers and acquisition, the share preference share exchange, what does that mean? What does it mean? Or what does it involve? This one currently involves offering preference shares of the acquiring company to the shareholders of the target company in exchange of their existing shares. So the acquiring company offers its preference shares to the target company shareholders in exchange for their common shares in the target company. And this exchange provides the target company shareholders with a more stable and predictable income stream, because we know preference shares the preference shareholders are paid fixed dividends. All right. And if the preference shares are convertible, there is also the ability to convert the preference shares at a later date into common shares of the acquiring company. And there are very many reasons why companies also prefer preference share exchange. Companies use the share preference share exchange in mergers and acquisitions for various strategic reasons. And the main reason is to appeal to specific investors, specific investor preferences, and to achieve certain financial objectives. One reason is to attract conservative investors. One reason is to attract conservative investors. Now, preference shares offer a fixed dividend, providing a predictable income stream, and this is attractive to investors who prioritize stability over high growth potential, such as retirees or risk-averse individuals. It may also reduce risk. Preference shares have a higher claim, the preference shareholders have a higher claim on dividends and assets in liquidation than common shareholders. So reduces risk, to reduce risk to the investors of the target company. It may also facilitate M&A deal or transaction. Understand? Offering preference shares can make the M&A transaction more appealing to target company shareholders who are maybe hesitant about the volatility of the common stock, or who desire a more stable income. There's the aspect again of bridging valuation gaps. Bridging valuation gaps, which I explained earlier. This method can help bridge valuation gaps. Right? Bridging valuation gaps. Another point is related to capital restructuring. Capital restructuring. This method can be very essential in capital restructuring. Adjusting capital structure. A company may use share preference, share exchange to adjust its capital structure, potentially reducing the number of outstanding common shares or even altering its dividend obligations. There could also be tax considerations, as explained earlier. Tax considerations. Depending on the jurisdiction, there may be tax advantages associated with the preference shares that make them attractive to certain M&A scenarios. So there are many reasons, candidates, why preference share exchange may be preferred in mergers and acquisitions. So in this lesson, we've discussed the 4 methods. One is outright purchase using cash. These are methods in financing mergers and acquisitions. The second one is share to share exchange. The third one is share debenture exchange. And lastly, we've discussed share preference share exchange. Thank you for attending the lesson. We continue to learn more about mergers and acquisition in our next session. Bye-bye.
Hello class, welcome to lesson number 4 of topic number 5, share capital. So in this 4th lesson, I want to talk about the purchase of own shares, by a company. Then I will also talk about dividends, the dividend law in respect to companies. So let me begin on the first of those items where we are talking about by purchase of own shares, by a company, where we are asking ourselves the question, can a company purchase its own shares? Or could a company, by extension, finance the purchase of its own shares? Now, we notice that there is a direct prohibition against companies purchasing their own shares or financing the purchase of their own shares. At common law, this is the rule in Trevor versus Whitworth, where the direction of the court is that a company must not a company must not purchase its own shares. A company must not purchase its own shares. Now, this is consistent with the rules that relate to the company's maintenance of its own capital. That the company's capital is the creditor's fund of last resort, and as such should be maintained. And all those matters, all those transactions of the company that go towards threatening the company's share capital, transactions such as reduction of share capital, transactions such as the company's purchasing its own share capital, all these are extremely regulated transactions by law in a bid to ensure the company's share capital remains fixed and known, remains unreduced, that there are measures that have been taken to ensure that the company does not waste its own capital. Now, despite this direction that a company must not purchase its own shares, the Companies Act gives us some special exemptions under which a company may be purchasing its own shares. So these exceptions include exceptions to the rule, that is exceptions to the rule in Trevor versus Whitworth. These exceptions introduce us to circumstances where a company may purchase its own shares. Now, one of those circumstances is during a redemption of redeemable preference shares, during the redemption of redeemable preference shares. This is if allowed by the articles, and all rules relating to redemption of redeemable preference shares have been followed. Rules that we have discussed earlier, such as the shares being fully paid, the shares being redeemed either out of the proceeds of a new issue, or if no fresh issue has been issued by the company redeeming them out of reserves and creating the share redemption reserve fund. We could also have a company purchasing its own shares in case of a valid surrender of shares by a member. This is a rare case, but very much possible, particularly where a shareholder holds partly paid shares, that the shares held by this member are partly paid. The fact that they are partly paid, they present a further obligation on that member to make payments for the balance, for the unpaid part of those shares. In the case this member is unable to make these further payments, in the event that this member is not able to discharge this liability, this obligation to pay for the balance outstanding on their shares, then they can surrender such shares to the company. This surrender, in a way, is to absolve them from that liability to pay for the outstanding amounts on their shares. The other possible circumstance under law where a company would be purchasing its own shares would be following a court order for protection, or for the purposes of protecting minorities. Where we have circumstances in the company, imagine circumstances such as a variation of class rights that is proposed and even voted accordingly, but we have some minorities who are contesting the variation of class rights on the basis that it is prejudicial to their own interests. We may have a court order directing that the interest of these shareholders, minorities actually, these protesting or these objecting minorities be absorbed by the company. In such an incident, the court could be directing the company to purchase the interest of these minorities, which the resulting transaction would be a company purchasing its own shares. So class, in these exceptional cases, they are presenting us to a scenario where we are going against the directions given by the rule in Trevor versus Whitworth, where the direction is a company must not purchase its own shares. However, we are saying in these exceptional circumstances, we can have a company purchasing its own shares. Now, by extension, we are also saying that a company must not finance or provide a guarantee, must not finance or provide a guarantee for the purchase, must not finance or provide a guarantee for the purchase of its shares, must not finance or provide a guarantee for the purchase of its own shares on the same premise that we were not to purchase our own shares for purposes of capital maintenance requirements. However, we are also finding ourselves running into exceptions to this rule, that we have exceptional circumstances where a company may finance the acquisition of its own shares. Now, these exceptions include where providing finance or guarantee is part of the ordinary business of the company. So this could be a company in the financial sector where part of their business is the provision of financial assistance, that they're in the business of giving loans. So a loan has been obtained by a customer in the normal circumstances under which normal loans would be borrowed, where such customer also proceeds on to purchase the shares of this company with the proceeds advanced by the company. Then we have a situation, an exceptional circumstance, where a company has financed the purchase of its own shares. The other exceptional case would be where the company has a scheme, to advance, money or funds to trustees, to a trustee or trustees to acquire shares for the benefit of its employees, Now, this exception presents us with a situation where this company has set up a trust fund or has set up a trust for the benefit of the members. And this trust, part of the things it does is investments for the purposes of the members. Remember, these investments could be through the purchase of shares, securities in companies. So we are saying funds have been advanced to the trustees by this company, where the trustees invest for the purposes of the members' welfare. These trustees could proceed on to use these funds in buying the shares of this company, advancing the funds. Now that presents us with an exceptional circumstance where the company is seen advancing funds, which funds are subsequently applied in the purchase of its own shares. Then finally, we have an exception where the company has a scheme. The company has a scheme to advance funds to employees. This is with an exception of directors, except directors to purchase shares in the company, for beneficial ownership. So company law recognizes that companies could have a scheme, an arrangement within the company that they advance funds, they advance money to the employees of the company, with an exception of directors. Directors are excluded from this fund. They are excluded from this scheme, this arrangement of advancing money to employees to purchase shares of the company for beneficial ownership. This scheme is to make the employees of the company feel part of the company, where they have been advanced money for the purposes of owning a stock in the company that they work for. So this is the idea of purchasing of own shares by the company, that it is generally prohibited in the interest of protecting the company's capital. However, we have seen ourselves running into exceptional circumstances where companies can directly purchase their own shares. We have also seen circumstances where companies are allowed by law to finance the purchase of their own shares. Let me now look at dividends. Dividends. We are describing a dividend to be a member's return. This is a member's return for their investment. A member's return for their investment in the company. A member's return for their investment in the company. It is also seen as a share of the company's profit, a share of the company's profit that is paid to the members. The share of the company's profit that is paid out to the members. Now, the Companies Act presents us with certain rules relating to the payment of dividends to members, relating to the sharing of profits or paying of this return to the members. Rules of paying dividend. Rules of paying dividend. Now, as part of this continuing story of maintaining the company's capital, one of the paramount rules relating to the payment of dividend is that dividends can only be paid out of profits. Dividend can only be paid. Dividend can only be paid out of profit. Dividend can only be paid out of profit. That unless a company has realized a profit, then this company cannot pay dividend. And by the way, inherently, companies are not under obligation to pay a dividend. It is financial year end, we have made profits. The company is not under obligation to pay dividend to the members. But we are saying, should we be paying dividends? Dividends must always be paid out of profit. It is unlawful. It shall be wrong. It shall be against the law to pay dividends where the company is not making profits. It shall be seen as paying dividends out of capital. Now, what will be considered profits? The company has what we call the realized profit of the company. Now, from the company's realized profit, it may create some part of this realized profit as the profits available for distribution as dividend. Now, in arriving at the company's realized profit, it could be considering any gains. We talk about realized gains. Any realized gains from revaluations. Any realized gains from revaluations of assets can also be considered as the company's realized profits in this year, including the exclusion or the deduction of any realized losses from revaluation of assets that this company has done during this year can be excluded from the company's annual realized profit that year. So from the company's realized profit, the directors will designate part of the company's realized profit as profit available for payment of dividend. Profit available for payment of dividend. The other rule is that dividend is recommended. Dividend is recommended by the board. Dividend is recommended by the board of directors. Dividend is recommended by the board of directors. These are the persons charged with the day-to-day management of the company. So they are best placed to know how much this company can afford to pay as dividends. So it shall be their responsibility to recommend how much dividend is to be paid. Still relating to the payment, we are saying that dividend is approved. Dividend is approved by members. Dividend is approved by members at a general meeting. Dividend is approved by members at a general meeting. Now, this meeting could be the company's AGM, at which dividend is usually approved by the members. So the directors have recommended a dividend, then we have a meeting of members where that dividend is approved. Relating to the approval, we are noting another rule that the members cannot recommend, let me withdraw the word recommend and replace it with the word approve. The members cannot approve a dividend above the rate, cannot approve a dividend above the rate recommended, above the rate recommended by the board, above the rate recommended by the board. So the board's recommendation on what dividend is payable shall be final. That in the GM's, the general meeting's approval, they cannot approve an amount beyond that which is recommended by the board. We are also noting that the company cannot pay dividend. The company cannot pay dividend if such payment will result to inability to meet its financial obligations. A company will not pay dividends to be unable to pay its salary to employees. A company will not pay dividends to be unable to pay rentals. A company will not be paying dividends to be unable to pay such expenses as are necessary for the running of this company. Now, once a dividend has been declared, something also happens that declared dividends, let's add the approval, declared and approved dividends, shall not bear interest against the company if there is a delay, in payment. That the board has recommended a certain rate of dividend, which has subsequently been approved by the members at a general meeting. Now, the usual practice is that once the dividend has been declared and approved, within 42 days of such approval, the dividend should be payable. If there is any delay in payment of such dividend, the suffering members shall not claim interest against the company for delay in paying them the dividends due. The other rule, still relating to payment of dividends, is that the company may deduct any amounts. The company may deduct any amounts owed to it by a member from the dividend payable. that the company can deduct any amounts that they are claiming from a member from the total amount they are to pay them as dividend. For instance, imagine a case where we have borrowed some money from our company and we have been unable to pay them. We have not repaid such borrowed amounts of money. So this company has some claim against us. So this rule is empowering them to deduct such amounts that they are claiming from any dividend that is payable to us after the declaration of the dividend. Now, from these rules, we can start imagining a procedure that companies follow in the payment of dividend. What procedures do we follow when we are paying dividend as a company? We will begin from a board meeting being held to recommend a dividend. After a board meeting has been held to recommend a dividend, the company will prepare and update the company's register of members, because it is on the basis of the register that this dividend is payable. Then we shall proceed on to convene a meeting of members where this dividend payment is to be approved. So once the dividend has been approved, then we have a preparation and closure of the register of members so that we have no more additions to the register after the approval of the dividend. Then the company can proceed on now to prepare the dividend warrants, which are to be counter-checked against the company's register of members. Then checks can be prepared and sent to members in respect of the dividend payable to them. So class, that brings us to the end of our lesson number 4. If we can recap what we have looked at so far, we have looked at the purchase of own shares by a company, where expressly such purchase has been prohibited, including the financing of the purchase of the company's own shares. But we have also looked at exceptional circumstances where such purchase can be done and the financing for the purchase can also be done. We have also looked at dividend, what it is. We have looked at the rules relating to payment of dividend, and we have also made a mention of the procedure to be followed by companies when paying dividends. I now want to send you to the revision partner questions, just to show you some of the questions that we have had from this particular topic. We have a question here asking candidates to advise shareholders on the distinction between nominal capital and reserve capital. We have a question asking candidates to explain 5 ways in which a company might alter its share capital. We have also a question here asking candidates to discuss the actions and omissions that are considered to contribute to criminal behavior in relation to preparation and issuing of prospectuses. So there are many questions here that I would wish to refer you to help you in the revision of the content in this topic. Thank you.
Hi candidates, welcome to another session of Manifested Online Classes. In this session, I want us to look on an illustration question regarding how to prepare the group accounts, whereby we have a disposal of interest. And the illustration I want us to go through reads, Pareto Limited is a holding company of a listed group of companies with its year ended on 30th of June 2021. So Pareto Limited has made a number of acquisition and a disposal of investment. So the following summarized draft statement of financial position relate to the group companies for the year which ended 30th of June 2021. So we are given the statement of financial position for 3 companies, Pareto, Paba, and also Dafu Limited. Non-current assets include property, plant, and equipment. Then we have investment in Paba, investment in Dafu. We have financial assets, and then we have the current assets. We have the total assets. At the equity, we have ordinary share capital, share premium, retained earnings, and then we have non-current liabilities and current liabilities. Then we have some additional information. Number 1, where we are told on 1st of October 2020, Pareto Limited acquired an 80% equity interest in Paba Limited when it retained earnings stood at 3,500 million. The purchase consideration comprised of 1,250 million of Pareto Limited shares with a nominal value of shillings 1 each and a market price of 6.8 each. At the acquisition of Paba Limited, the only adjustment required for to the identifiable net asset of Paba was for land which had a carrying amount of 625 million less than its fair value. So number 2, we are told the group policy is to measure non-controlling interest at fair value. That information definitely is to guide you how to compute the goodwill. If you come across that information that the group policy is to measure NCI at fair value, it means that when computing the goodwill, we then compute that goodwill using the full goodwill method. And then you're told at the date of acquisition of Paba Limited, the non-controlling interest had a fair value of 21.25 million. Number 3, Pareto Limited had acquired 100% equity interest in Darfur a number of years ago when it retained earnings amounted to 1750 million. At acquisition, the fair value of identifiable net asset of Darfur approximated their carrying values. The purchase consideration comprised cash amounting to shillings 5750 million. Number 4, you're told Pareto Limited disposed of 60% of its investment in Darfur on 1st of April 2021 for shillings 4,700 million, when the fair value of identifiable net asset of Darfur were shillings 6250 million. The fair value of the remaining 40% equity interest was 4,300 million at disposal. Pareto Limited has not accounted for the disposal. And then number 5, you're told none of the companies had issued any shares since Pareto Limited acquired its shareholding in them. And number 6, you are told neither the goodwill on acquisition of subsidiaries nor investment in associate, that is, had been impaired. So from that information, what you're required to do, number 1, is we compute the goodwill arising on acquisition of the investment in the subsidiaries. Number 2, to compute the gain or loss arising on disposal of the investment in Darfur as reported, Roman 1, the individual financial statement of Pareto, Roman 2, consolidated statement of profit or loss, and finally part C of that question we are required to prepare the consolidated statement of financial position as at 30th of June 2021. So these are questions for group account, and as usual what we need to do first of all is to come up with a group structure. Then we go through the additional information, we see whether there are workings which we need to do, and then from there we prepare, or basically we compute what is required. So therefore, let's first of all we come up with the group structure here, which will be working 1, a group structure. A group structure. So where do we get that particular information about the group structure? So that information we have it from the additional information number 1, whereby we are told on 1st of October 2020, Pareto Limited acquired 80% equity interest in the company which is called Paba Limited on 1st of October 2020. 1st of October 2020, and also we are given the retained earnings of Paba on that date. That one will be used in the computation of goodwill, including the purchase consideration. That one will be used in the computation of goodwill. But let first of all we go to the additional information number 3, whereby we are told Paba Limited, not Paba but rather Pareto, Pareto Limited had acquired 100% equity interest, 100% equity interest in the company which is called Darfur Limited a number of years ago. So in this case, we are not given the specific date of acquisition, but we are told Pareto Limited had acquired 100% shareholding in Darfur sometime back, or basically a number of years ago. So basically what that means is that from this group structure here, Pareto Limited, this will be the parent company, and automatically the parent company is the one which is supposed to prepare the group account. Then PABA is a subsidiary, and also DAFU here is a fully owned subsidiary, a fully owned. Fully owned means that the parent company acquired all the shares or hold all the shares in that particular subsidiary. So we have that information, but also before we go maybe back to note number 1, there is another information which is given and which is very, very important in note number 4, sorry, where we are told Pareto Limited disposed of 60% of its investment in DAFU on 1st of April 2021. So that is information about disposal of interest. Disposal of interest. Disposal of interest, whereby we are told Pareto Limited disposed 60% shareholding in what? In DAFU. So we have disposal of interest in DAFU Limited. So, and automatically this particular disposal of interest, this usually take place during the current financial year. Now, first of all, if we go to the information we have at the paragraph 3 up there, so the current financial year was all ended on 31st of or that is June 2021. So basically what that means is that this year started on 1st of July 2020. But now if we go back to the information we have in note number 4, we are told Pareto Limited disposed 60% of its investment in DAFU during the current year. So that is the 1st of April 2021. 1st of April 2021. So how many months do we have here to the date of consolidation? We have April, May, June. So here we have 3 months, and automatically here we have what? 9 months. So what that means is that for the first 6 months, this particular company here, that is DAFU, this was a subsidiary, because you can see in the first 9 months, the parent company had 100% shareholding. But on this date, we are told the parent company disposed 60% of its shareholding in DAFU. So that what that means is that the parent company retained 40% shareholding in DAFU, and therefore DAFU in the last 3 months was an associate. And therefore, if for example in this particular question here the examiner was requiring the candidate to prepare the consolidated income statement, it's very, very important to note that this company here, that is DAFU, for the first 9 months you treat it as a subsidiary, meaning that you take into account its revenue and expenses for the first 9 months, for the first 9 months, and then you add that to the revenue and expenses of the parent and the revenue and expenses of what? Of PABA. But in the last 3 months, that is, DAFU Limited will be an associate, and therefore what you need to include in the consolidated income statement is the parent company share of DAFU Limited profit after tax in the last 3 months. And also in this case, because the parent company lost the control, you have to determine the gain or loss on disposal, which then you recognize in the income statement as part of the profit or loss. But in our case, if you check on what the examiner was requiring here, specifically in part C, we are only required to prepare the consolidated statement of profit, the consolidated statement of financial position. So what that means is that in preparing that, we check the status, we determine the status of DAFU at the end of the year. DAFU Limited at the end of the year will be an associate, and therefore in preparing the consolidated statement of financial position, we are going to add similar items of asset and liabilities, those of Pareto, the parent, and those of PABA, but we are not going to take into account the asset and liabilities of DAFU because it's an associate. So what we are going to do is we are going to determine something called the investment in associate, and basically that is the only item we are going to include in the consolidated statement of financial position as far as DAFU Limited is concerned. Yes, that is why the group structure here is important. But before you do that, maybe you can just go through this additional information, again, we see whether there are some workings which are required. Note number 1, we go back to note number 1. We are given information about the acquisition of PABA, and actually the retained earnings, the purchase consideration, all that will be used in the computation of goodwill, which you are required to compute as per part 1 of that question. And also we are told that at the date of acquisition, PABA Limited, or at the acquisition of PABA, the only adjustment required to the identifiable net asset of PABA was a LAD with a carrying value of 625 million less than the fair value. So basically what that means is that this company on the date of acquisition devalued the asset, and remember that process, we refer to it as the fair value adjustment or the fair value exercise. So this is by PABA Limited, and the asset it revalued was LAD, and we are told that this LAD had a carrying amount of its carrying amount was 625 million less than the fair value. So in this case, the carrying amount was less than the fair value with an amount of 625 million. In other terms, we can say that the fair value, we start with the fair value, was greater or was more than the carrying amount with 625. So automatically, what is this? This is a revaluation gain. And this particular revaluation gain, which occurred on the date of acquisition, automatically was not accounted for by PABA. So therefore, in preparing the consolidated statement of financial position, this one we added to the group PP, and number 2, this one we treat it as a pre-acquisition revaluation reserve, pre-acquisition revaluation reserve. In computing the goodwill on acquisition, that will be one of the component of the net worth asset of PABA Limited. So I think we have that particular information there. And then it is also important to note that this particular asset here, that is LAD, this is not a depreciable asset. LAD is not depreciated, and therefore in this case, no depreciation other charge. No depreciation other charge to be computed here, simply because LAD is not depreciable asset. But if this was a depreciable asset, we needed to compute the depreciation other charge. So let's move to, but we will still come back to that particular point, specifically in answering part A of that question when computing the goodwill. So in number 2 is about information regarding the computation of goodwill. We will still use that in answering part A. And then part additional information number 3, we are given information about the acquisition of Pareto, where we are told the parent company, that is the acquisition of Dafu, whereby we are told Pareto Limited had acquired 100% shareholding in Dafu some time back. We are given it retained earnings there, and also the fair value of identifiable assets, which we are told equaled to the carrying amount. So mean that at the date of acquisition, this company revalued the asset, and the fair value of identifiable asset was equal to carrying amount. There was no revaluation gain or loss. And then you're given the purchase consideration, which was 5750. All that information we're going to use it in answering part A, specifically in computing the goodwill. And then we're given information number 4 about the disposal of some disposal of interest in Dafu. And also this one we're going to use it in answering part B of that particular question. And then we have note 5. Note 6. I think no working which is required here. So I think we can go straight to part A of that particular question. Part A of the question. So what we are required to do is to compute the goodwill arising on acquisition of investment in subsidiaries. Investment in subsidiaries. So we start by computing the goodwill arising on acquisition of the first subsidiary here, that is PABA So let's start by computing the goodwill arising on acquisition of investment in Paba Limited. Paba Limited. Equally, remember, as per the information which are given in note number 2, we are computing the goodwill using the full goodwill method. That's the first thing you need to appreciate, or basically to note. So how do we compute the goodwill using the full goodwill method? Number 1, we take the cost of investment. The cost of investment. So how much purchase consideration was paid by the parent company in acquiring the shares of Paba? So that information, we have it in the balance sheet or in the statement of financial position of Pareto, specifically at the non-current asset. We are given the amount of the amount invested by Pareto in Paba, which is 8,500. 8,500. So to this, then we add the NCI at fair value because you're using the full goodwill method. So this figure is also given in note number 2. Additional information number 2, the last sentence we are told, at the date of acquisition of Paba, the non-controlling interest had a fair value of 21.25. So we add the 2. So this will give us 25, 10, 6, 10, 6. So let's confirm whether that is correct. So we have 85 plus 21.25. So which will give us 10,625. That is correct. So then from there we proceed and we less fair value of net assets. Fair value of net assets acquired. So how do we compute this one? Because it's not given. So we have to determine the fair value of a net asset of Paba on the date it was acquired. And we determine that by taking the ordinary share capital of Paba plus pre-acquisition reserves. Pre-acquisition reserves. So therefore, where do we get this? Let's go back to the statement of financial position of Paba, specifically at the equity. At the equity. So at the equity, number 1, we are given the ordinary share capital of Paba. The ordinary share capital of Paba is a figure of 25. Still, in that case, we also have a share premium. Share premium of a subsidiary company, unless told otherwise, is always taken to be a pre-acquisition. Then the retained earnings, which we have there of 5250, that is at the end of the current year. That is not what we're interested with. We're interested with the retained earnings of Paba on the date it was acquired. And that is now what we refer as the pre-acquisition retained earnings. So that one is given in the additional information number 1, whereby we are told when Paba Limited was acquired, its retained earnings stood at 35. Stood at 35. And then to this, other than taking now the items in the statement of financial position, specifically at the equity, you also have to check whether this company revalued its asset on the date of acquisition. In case it revalued its asset, was there a revaluation gain or loss? So like in our case, remember here, Paba Limited revalued land with an amount of what? 625. This one we have said is a pre-acquisition revaluation reserve. A pre-acquisition revaluation reserve, which is 625. Yes, I think that's what we have. And basically what we need to do here, we get now the total. So we have 25 plus 1,000 plus 35 plus 625. So this will give us 7625. And because we are using the full goodwill method, we take 100% of this. 100% of this will be 62. That is 7625. We less it from the figure up there. We less it from 10,625, which will give us goodwill on acquisition of what? Of 3,000. So that is the goodwill on acquisition. And remember that is a full goodwill. Basically the goodwill determined using the full goodwill what? The full goodwill method. So basically that is what is required there, and basically the items which are marked in such a case are those items which we have there. Then we need to proceed and compute the goodwill on acquisition of the other subsidiary, that is the full goodwill on acquisition of goodwill on acquisition of Darfur Limited. Darfur Limited. So we need to have two columns here, and even before you compute now the goodwill on acquisition of Darfur, it is very, very important for you to note that in Darfur there is no NCI here. There is no NCI because you can see that the parent company acquired all the shares, acquired 100% of the shares issued by what? By Darfur. So therefore in Darfur you don't have what? NCI. And that's why you can see, despite the group using the partial goodwill method, the full goodwill method in computation of goodwill, we are not given the NCI at fair value in Darfur, simply because there is no NCI. So therefore what we do here, we take the cost of investment, the purchase consideration paid by the parent company, that is Pareto, in acquiring shares of Darfur. That one is given in the statement of financial position of Pareto under the non-current asset, which is 750, and then in this case we should add the NCI at fair value, which you are saying is 0 because we don't have NCI. We don't have NCI. We get 5750, and then to this we proceed with less fair value of net assets acquired. Equally, to compute this, we take the ordinary share capital of Darfur plus pre-acquisition reserves plus the reserves it was having on the date it was acquired. So where do we get that? Let's first of all we go to the statement of financial position of Darfur, specifically at the equity section. So the ordinary share capital of Darfur is 2,000. Also Darfur had a share premium of 500 or 500, and then the retained earnings in the statement of financial position of Darfur 5750 is at the end of the current year, but that is not what we're interested with. We're interested with the retained earnings of Darfur on the date it was acquired, and that is given in the additional information number 3. Pareto Limited acquired 100% equity interest in Darfur a number of years ago when it retained earnings. Earnings stood at 1750, and also you check whether Darfur Limited revalued its assets. So basically, as per the information which are given in note number 3, this company revalued its asset, but you are told their fair value was the same with the carrying amount. There was no revaluation gain or loss. So what we do, we get the total here, and then we less that from the figure we have down there. So we have 2,000, which will give us 2,500 plus 1750. So which will give us 4250, and then we take 100% of this. 4250. We less it from this figure minus 5750. 5750, which now will give us a goodwill of that, which will give us goodwill of 1500. So basically that also what was required there, and automatically the items to be marked there include what we have there, that and that. And basically by computing the goodwill on acquisition of the two subsidiaries, the marks allocated there were 4. So let's move to part B of that particular question. Part B, we are required to compute the gain or the loss on disposal of investment in Darfur, investment in Darfur Limited, Roman 1, as it was reported in the individual financial statement of Pareto, as it was reported in the individual financial statement of Pareto. Now, in this case, when Pareto Limited basically invests, or the parent company invests in a subsidiary, to the parent company, that investment in a subsidiary is like an asset. And therefore, once the parent company sells some of the shares, or basically all the shares in a subsidiary, the parent company in its individual financial statement, not in the group account, in its individual financial statement, it will need to recognize the gain or the loss on disposal. Now, that gain or loss on disposal is computed by taking the sales proceeds. The sales proceeds is basically the amount of money which was received by the parent company after selling some of the shares or all the shares in the subsidiary, minus the carrying amount of investment, disposed. Investment disposed, or basically investment sold. And this one is very simple because all these figures are given. So let's go to the additional information number 4, and you're told Pareto Limited disposed 60% investment in Darfur on 1st of April 2021 for 4,700. So that 4,700 is the sales proceeds, the amount of money received. Yes, and then to this, what we know is that the amount of money which Pareto Limited had invested in Darfur is 5750, which is given in the balance sheet of Pareto. The amount invested in Darfur was 5750. In the statement of financial position of Pareto and current asset, the amount invested in Darfur 5750. But in our case, we know the parent company only disposed 60% of that. So that is the carrying amount of the investment sold. So that's how we compute the gain or loss to be recognized in the individual financial statement of Pareto. So this will give us what? 60%, 5750. We less that from 4,700. So this will give us 1200. And basically that is a gain. That is what? That is a gain. That is a gain. So basically by doing that, the candidates here were allocated how many marks? Were allocated 2 marks. 2 marks for computing that. You can see that was quite straightforward. Also, in part B, we are required to compute the gain or loss to be or as it will appear in the group account, as it will appear in the consolidated statement of profit or loss. So this is now the gain or loss to be recognized in the group account. So this is something we discussed in our previous session, how to compute the gain or loss arising from disposal of interest. So in terms of how we compute this, we take a number of figures here. Number 1, we take the fair value of consideration which was received. How much amount did the parent company receive after selling the 60% stake or interest in Darfur? So that figure, we already have it in note number, additional information number 4, and which was 47. And then to this, we add the fair value of investment retained. Fair value of investment which was retained. Still, we have that in note number 4 as a figure of 4,300. The fair value of the 40% equity interest which was retained was 43. After adding those two figures, we proceed and we less two items. Number 1, we less the parent company unimpaired goodwill. Parent company unimpaired goodwill, and that is something we have already computed here. The goodwill arising on acquisition of Darfur, this figure here, And we also have to note that this particular goodwill here, despite computing it using the full goodwill method, this is a goodwill attributable to the parent company, because in this DAFU we don't have NCI, because generally here what we take into account is the parent company goodwill, which is not yet impaired. So this goodwill was not impaired as per the information given in note number 6, and the full amount is the goodwill attributable to the parent company. So that is what we list here. And then we also list the fair value of net assets at date of disposal. At date of disposal. So what was the fair value of the full limited net asset on the date of disposal? That information, we also have it in note number 4. We are told on 1st of April 2021, the fair value of identifiable net asset of the full was 6250. Or 6250. So that's how we determine the gain or loss on disposal to appear in the consolidated, or to be recognized in the consolidated statement of profit or loss. So we have 47 plus 4700 plus 4300 minus 15 minus 6250. Is that will give us 1250, which is a positive figure, and that is a gain on disposal. The gain on disposal. And actually that what was required in that part there, and basically by doing this, the marks allocated there were 2. So these are the items automatically which were marked. So let's move to part C of that particular question, whereby we are required to prepare now the consolidated statement of financial position, which you have said is simple, because what we need to do is to appreciate the fact that this will be a subsidiary at the end of the year, and then the full limited at the end of the year, it will be an associate. So therefore, in preparing a consolidated statement of financial position, we combine similar items of asset and liabilities, those of the parent and those of the subsidiary, and then for the full, we just compute something called the investment in what? In associate. So therefore, let's do that. Part C. So the name of the group here will be a Pareto group. This is a consolidated statement of financial position as at 30th of June 2021. 30th of June 2021. So here we just need to have a single column, and our figures are in thousands of shillings, in million of shillings. So we start with the non-current assets. So first of all, we have the PPE. So PPE, we are taking the PPE of the parent, recall that, of the parent, that of PABA. We are not including those of DAFU. DAFU is an associate. We don't consolidate asset and liabilities of an associate with those of the parent. What we include here, as far as the associate is concerned, is something called the investment in associate. So therefore, we are only adding the PPE of Pareto and those of PABA. We have 14,900 plus 9250, and then we check whether we have any consolidation adjustment affecting the PPE. Do we have any consolidation adjustment? Yes, this one. On the date of acquisition, PABA Limited revalued its asset upward with an amount of 625, which was not accounted for. So we add that here, 625. So remember, we don't have any depreciation other charge, which would have been deducted there. So then below the PPE, we'd have investment in PABA, investment in DAFU. So those investment, we don't include them here, but as far as PABA Limited is concerned, which will be a subsidiary at the end of the year, we include its goodwill here. So the goodwill on acquisition of PABA is 3,000. And then for DAFU at the end of the year, remember, it will be an associate. So what we include here as far as the associate is concerned, associate or investment in DAFU Limited. So in our previous session, we looked on how to compute this, and actually we said to compute investment in associate, we take the investment, that is, we take the fair value of the investment which has been retained. So which is what you're given here, 43. And then to this, what we add is the group share of the post-acquisition net asset in that DAFU. So how do we get the group share or the parent company share of the post-acquisition net asset in DAFU? So what we do is that we take the net asset of DAFU at the end of the year, and basically by now we know that the net asset of a subsidiary is always equal to equity, share capital and reserves. So what is the equity of DAFU at the end of the year from its statement of financial position? You can either take the asset minus liabilities or you just take equity. The total equity of DAFU, which is the same with the net assets, is 8250. This is the net asset of DAFU at the end. But now the date DAFU Limited became a subsidiary, became an associate, sorry, its net asset, you have to recall in note number 4, we were given as a figure of 6250. So therefore, whatever the difference here is the post-acquisition net assets. So we get the parent company share of this, which will be 40%. Which will be 40%. So this will give us a difference of 2,000, 40% of 2,000, 40% of 2,000. This one is 800. We add it to this, which will give us 5,100. So that is now the investment in what? Investment in DAFU, which you are saying will be included here as an item of non-current asset. Okay. So then below that, we also have the financial assets. Financial asset, no adjustment for this. We just take the financial asset of the parent, 31, plus those of the subsidiary, 28. This will, and then from there we have the current asset. Actually, for current asset, we are given the total, 3850 plus 4425. Do we have any adjustment to the current asset? We check for things for like intercompany debts. We don't have things like unreleased profit. We don't have. So mean that no adjustment for this. So what we just need to do, we get the final figure. We get the final figure. We have 3850 plus 4425, which will give us 8275. We get the total assets. The total assets. So let's first of all we compute the figure for PP there. We have 14,900. There is something we have forgotten here before we add here. So this particular purchase consideration which was received, that is a figure for 47. This amount was not yet accounted for. So therefore is amount receivable. It was not yet paid. So we also include it as part of the current asset. We also include it as part of the current what? Asset before we get the final figure there for PP. So let's add 47, 8275, 8275 plus the purchase consideration received, this one, which will give us 12,975. Okay, so we get the final figure for PP. We have 49 plus 9250 plus 625, which will give us 24, that is 24,775. Yes, and then we can add all these figures now, plus 3,000 plus 51 plus 59 plus 12,975. So that will give us a total of 51,750. So these are total assets. So we proceed, record equity. So for equity, we record the ordinary share capital, that of the parent company only, which is the 10,000. The share premium for the parent company only, 5,000. Then from there we will compute the group retained earnings, interest, and the non-controlling interest here will only be computed as far as or in relation to, or we are going to compute this for PABA. PABA is the one which was a subsidiary. Remember, DAFU is an associate. So then from there we have non-current liabilities. So for non-current liabilities, we are given the total. So we have 85 for the parent, and that for PABA, no adjustment here. So we get a total of 14.5. And then we have the current liabilities. Current liabilities, we have 47.75 plus what? Plus 17.25. We don't have any adjustment there. We get total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So let's first of all we add these particular figures here. For current liabilities, we have 47.75 plus 17.25, which will give us 65. And then for the non-controlling interest, this one we can compute it directly because the group policy here is to measure NCI at fair value. So when that is the case, then the computation of NCI is quite simple, because what we do, we take the NCI at fair value on the date of acquisition, which is 21.25, plus now the group share. The group share of what? The group share of post-acquisition adjusted retained earnings. So the retained earnings of of PABA Limited after it was acquired, how do we get that? We take its retained earnings at the end of the year. The retained earnings of PABA at the end of the year in the statement of financial position is 50.
if we can start with task one. If you have gotten the worksheet, you should probably open it on your computer if you have access to your computer. Then we'll start with the tasks. So task one says insert a new row at the top of the worksheet and insert the heading. I think here, this one I wanted to say insert the title, New Day Motors September imports. So there is a car dealer of some sort here. They've imported these vehicles. We have the cost. We probably be asked to do the duty, the shipping, and then the total cost. So what we want to do is follow these tasks, right? So if there is anyone amongst us, how do we insert a new row up here? We want something at the top of the worksheet. To insert a new row, we had not discussed this before, but I'm sure probably there's someone amongst us who will know how to do this. So I'll point at where the one is, number one, and right click on that and there will be an insert option. So just click that, you get a new row, right? So, and the same works for if I wanted to insert a new column and so forth. We don't want a new column right now. So what we want to do is insert that heading. Let's see, New Day, calling it New Day Motors September imports. So what does the next task say? Format the title to be bold and size 30. So we apply some basic formatting. So to format this, we will of course highlight it, then go to the home tab and click on bold. When they want it size 30, we change that here. Sometimes you will find that the size you want to put is not listed here. Like size 30 is not amongst these ones. So what do? We just type it directly and we get a size 30, right? So that's size 30. Then they want the cells merged in the range A1 to G1, right? I can see this font is already quite big. Maybe I should adjust the size. But let's see. Highlight this to merge the title, to merge the cells. We will highlight the range from A1 to H1. Then I will go to the home tab and click on this merge and center. So it merges it within that range. The only issue right now is that it doesn't fit, so I can adjust a bit. What I've done is drag this a little to make sure that the whole of the title shows. Okay, I hope we're together up to that point. So that is formatting. Let's see, yeah, there is one more formatting thing. We're supposed to apply visible table borders on the spreadsheet. We want some visible borders. So this part is going to be visible. So to apply borders, highlight the whole range where you want to apply the borders. Then we can again use the home tab and borders are here. So there is this font group, this ribbon, font group, borders, and click on borders and you have borders there. Okay. That's clear. So let's try do some calculations now. We are applying some of what we have been learning. And this is where I want to get some interactivity out of you. We have been told to calculate duty. The duty, the rate for the duty is 40% for cars that cost 5,000 US dollars and below, and 55% for the rest. That means for vehicles that cost above 5,000, the duty is higher, it's 55%. So if anyone can recall from our discussions, what do we need to do here? What will we be using, a formula or a function? And if it's a function, what function shall we use? Okay, let me review this one for you. Now, we talked about the if function. The if function is a conditional function. Remember here, the condition is The duty changes according to the amount, the cost of the vehicle. So if the vehicle is above 5,000 USD, duty is this. If not, it is this other one. So it just sounds like an English sentence. So we have equals, then we start at the if function. If, then we will click this. So it should read like an English sentence. If the cost is above or equal to 5,000. Okay, if the cost is above or equal to 5,000, then what happens? So we have to have a then clause. This is called the condition. If that condition is true, then we have started with a greater than, actually, come to think of it, because here it says 5,000 and below. So we need to change this to answer the question correctly. We are less than or equal to, and notice the order of these symbols. You have to start with a less than sign followed by the equal sign. Sometimes students mix them up. You start with equals, then less than, and it doesn't work. So you put them in the order in which you say them. Less than or equal to 5,000. Then the duty is 40%. If you recall from our last lesson, I remember we did a bit of a function. You have to say 40% of what? If I just wrote 40%, then I'll get the wrong answer. Or rather, I'll just get 0.4 because 40% is 40 out of 100. I need to say 40% of what? 40% of the cost. Okay, so the duty is 40% of the cost. Else, so if this value does not meet the condition, the value in here does not meet that condition, then the duty is 55% of the cost. Right? Very important to remember there. Otherwise, there are some cases where a student will work out this. They will put the 40% and not put the value. Let's just see what would happen. If you didn't put 40% of what you're trying to get, you'll get this. And then you will wonder, why is my formula not working? Because you've not said 40% of what, or 55% of what. So you can use this to actually also check what rates are being used for the duty. Anything above 5,000, you'll see it is 0.55. This one is 0.55, which is 55%. So we need to specify it is 40% of the cost. That is how we do it. Remember, we have talked sometimes about clicking on the options rather than typing them. Then when you click, that is when you're able to auto-fill like we have done. You can also try the next one, shipping. Shipping is, again, straightforward. It is 15% of the cost for all vehicles. So that one should be a straightforward calculation, equals 15%. Okay, we said you use a percent sign. The percent sign is shift and 5. There are those people who will do 15 over 100 times the cost, which will still work, but there's no need to do that when you have the percent sign. So we use the tools that are available on the spreadsheet. So 50% of the shipping, or rather the cost. Then we drag this down, and then we have the shipping cost, right? Then the total cost, as you would guess, will be the sum of all this, right? So how do I get the total here using one function that we have learned so far? So select everything, including the cell where you want the solution. Then we can click on this auto sum sign. In fact, you can do all of them at the same time. So if I undid that and did this, then click on the auto sum, then you get all the answers. Okay, correct. This, it shows we are learning. Okay, so cost, what we want to do is also fill out this section here. We want to do a bit of analysis. Okay, so this analysis, I want to get the number or based on every make. Okay, so I want to get, say, the number of Subarus, the number of Toyotas, and so forth. So there are different types of cars here. So I want to use the make field and get the number. So what I actually need to do here is to adjust this. See, instead of having this, do this, and then I'll move this. I can move this around. Again, part of it is, suppose I wanted to move this to the end. Let me put them here. So I can do my analysis around there. And instead of this, I will write names of every make. Toyota. Then I have Volkswagen. You can correct that even on the worksheet you received. And I think the last type of vehicle is Nissan. So that one is getting the number based on the make. But we can also do some analysis based on the category. So all of this is make. So I can merge that and put a small title there and say make. And then I've included an extra cell, so correct that by going back there to unmerge and then merge afresh. Then I'll do some analysis here by category. So I'll just type category. And there are how many categories? There is station wagon, then there is SUV, then I have sedan, then I can make this smaller, adjust this a little. Then I have what other categories? Sedan, crossover. And I think I have a van. Let me make this a van as well instead of making it a minivan. Van. Right, so what we want to do is to use some functions that we have learned also the past few days or weeks to fill in, to do some analysis on this. Before we learn new things, we need to master the ones we have already learned. So what we want is remind ourselves, what function shall we use if we want to display the number of Subarus, for example? How many Subarus are on this list? Shall we use? Who remembers the function? Okay, so that is count. Tried, but not quite count. You've gotten it partially correct. What are we counting? When you use count, if I remember correctly, in the last lesson, we said if you use count by itself, count only counts numeric values, all right? We talked about count and count A. So we call these two. This one counts. You need to use count if correct. Count if is a correct. So we are counting with a condition. So equals count if. Open a bracket. Then I light the range, and you need to specify what you're counting. So the criteria, and it gives you a prompt over there. So we have the first one we're counting is a Subaru. Said because we are now familiar with Excel, we don't need to go typing the formula over and over again. We can find a way of auto-filling the formula, copying the formula all the way, say up to here for make. We can even let's put some different colors here so that we see it is different type of data. I can use some green. I can put a green fill of that section and put some borders, and I can put a different fill here to differentiate the sections. Put a light blue fill and apply a border. So I want to copy the formula here and here. Can anybody recall again from our discussion in the last lesson, is something we said. If I tried copying this one directly, I'll get something that doesn't seem to be very right. First of all, I'll get zeros. And another problem is that it's still counting Subarus, right? So even if I change this, let's say I change this to Toyota. Let's see if it will give us the correct answer. Change it to Toyota. I still get a 0. So it's still not counting the things I want. But if you look carefully, this range is B3 to B14. But this range is C3 to C14. So it has moved from here to here. It's looking for Toyota here and it can't find any Toyotas because that is a make, right? And you'll even get an error message, right? So what we want to do is to, while we are still here, we use absolute referencing. If you remember, we were pressing FN and F4 to apply those dollar signs. So that locks the reference to that section, to that range. So if I copy this now, I get some 3s. So there's a bit of hope. At least I have something. It's not showing me zeros. The only problem now is easy to spot, is that it's still counting Subaru when I need to change that to Volkswagen and Nissan. So I'll start with Nissan. I just need to change that to Nissan. And either type it. If I had a list of those types somewhere here, I could use that range. We'll check. I'll show you that in a minute. So Nissan, it tells me the 2. Then Subarus, need to change that from Subaru to Volkswagen. Right, so it will count the Volkswagen, it finds 3, then we put Toyota and see how that will change. And those ones are 4, right? So, and you'll notice if you make any changes here, it will automatically be reflected. So what I'll say is, if I had this, a list of this somewhere, Toyota, Volkswagen, and I have the next one, Nissan. In category, so I have Subaru, Toyota, Volkswagen, and Nissan. I can still use a range that is somewhere on the worksheet to do what I've just done. So if I kept this range, then instead of this Subaru here being there, I can click on this. So it will still look for Subaru. My search criteria will be whatever is contained in that cell. I hope that makes sense. Then if I want to drag it across, then it would make more sense if I put this one in this, somewhere in these cells. So if I put them across like that, then I will be able to autofill directly. So because this is referring to L14 now, so that is L14 where Subaru is, then I can autofill like this. And you see the numbers remain the same because this one has Subaru. When I go to the next one, M14 now has Toyota. See, that's M14. If I go here, that N14 has Volkswagen, and that O14 has Nissan. So that's one way to do it. Unless this is, I don't think it's very confusing. Sometimes it saves you a few minutes of typing. If I had them here, then I would not have to go typing the names again there. But even typing will still give you the same result. Right? I hope that is not too. All right, let's try to apply the same formula to work out how many station wagons there are, how many SUVs there are, and so forth. Get the numbers by category. It will still be the same formula, so I'll do equals count if then I open a bracket, then this time I'm using this range, then I'll press F4, that is function F4 because I'm using a laptop. Then I put a comma, and I could do one of two things: write those the different categories here. Alternatively, just type them in directly. So let me just make the other point. So type them in, then I can do that. And if I copy this formula, I then have to go changing them. Like this one now will read station wagon, and I want it to read the van. I have to remember to change that one inside there to tell me there are two vans. Then I want to change this category to crossover to tell me how many crossovers are. There are 3. Then the next category is sedan. And so forth. Close the bracket. And there is SUV and so forth. Right, so we have used the count if formula. Remember, we have used that formula in very many different scenarios. The point is, presented with different scenarios, you should be able to choose the correct function and apply it. Okay, so what we have done so far is we've kind of gone around the same functions in different scenarios to just make sure that you internalize their usage, their syntax, and their application. Okay, so let's talk about the average cost. We want to get the average cost by make, the average cost of a Subaru, the average cost of a Toyota, the average cost of Volkswagen, and so forth, the average cost of a station wagon, the average cost of a US SUV. Average if given pop. So average if, then we have our criteria. So we want to get the average cost. So we'll use this total cost tool. Where are we looking for Subaru? We'll select that range, then lock it. So I'll not go through the detail of locking again. Then what is the criteria? We are looking for a Subaru. So I can even use this directly. Let me lock that Subaru there. Or I don't even need to lock it, but if there's no harm, then I'm doing the average of the total cost. So FN4, that should give the average cost of a Subaru. Okay, it looks like a very long formula, especially when you have the absolute signs. But just to break it down again, is let me expand it so we can make it slightly bigger so you can see it clearly. It says average if this range, it looks at that range for that thing. So it is looking in this range, which is that range, the make for Subaru, and then it will get the average of the total cost. So this is where it gets the value that it is working out the average of. So there's three, they're called parameters. This is a function with 3 parameters. It has the range where you're looking for that thing in the second section, and the range where the calculation comes from. All right. So I'll put that back, smaller size, and remember shortcuts. I'm using Control Z to move backwards. Then I can look at this and see the decimal points are a bit too many, then reduce those decimal points using this. If we have land, let's make it 2 decimal points because it's money. Then we go to Toyota. We'll use the same idea. If I autofill these ones, let's autofill this and see what the problem is. We get the same answer. So that's not a bad thing. It means there's only one thing we need to change. So those who are getting what I'm saying, what do I need to change in order to get different values here? What do I need to change? Okay, so let me help you see it. So if I double click this, if you look at those variables there, there's range, criteria is the middle one, average range is the last one. So you can tell that this middle one is what is determining what the average will be, because this middle one is the one that represents that Subaru. Okay. So what I need to change is that middle one. Right now it's referring to the Subaru, so I need to change that to